A'udhu billahi minash shaitanir rajim. Bismillahir rahmanir rahim. As we begin today, welcome to some real change stock option trading journey. I am your host, Abdul Shabazz. And this is some real change stock option trading journey. And today, the very last day of the month of July for the year of 2024, there will never be another July the 31st of 2024. So grateful to be here. We also know what is going down today. If you don't know, FOMC, okay? So right off the bat, we want to give a shout out to T-Shirts for Traders .co, because whenever Powell speaks, pretty much sums it up. Yes, sir. And since we have FOMC today, I will not be trading until 2 o'clock. I know, guys, I know, but we don't want to push it. Why push it? There's plenty money to be made. The markets will always show us areas where we can take profits in the charts. But big money is going to set aside until the FOMC report. So if big money is going to set aside, then I'm definitely setting aside with my smaller money. So I am here. The charts will be up. The team will be present. But we will be observing this morning. Yes. Observing this morning, as today is FOMC, and we already have a very, very ridiculous post and pre-market move from yesterday's close. Okay, think about where the market closed yesterday at pretty much 542. So right now already being at 549. An incredible jump. An incredible jump. Incredible jump. Over $7 post and pre-market without you and I even being involved. Unbelievable. And it is for that reason I will be standing down. Look at that huge buying algo from a low of 537 to 549. Over $10 gap up. Post and pre-market. No retail trading involved. Good morning. And I pulled up TradingView and couldn't believe how much I had to scroll to find the level of pre-market. Matthew says, Matthew, good morning to you. And it is for this reason, Matthew, that the market gapped up. Over $10. Over $10? Post and pre-market? Nah, buddy. With FOMC coming out today as well, I will not be trading this morning. I'm sorry, guys. I'm sorry. But Powell is speaking at 2 o'clock, and I am just going to wait to see what the news is and what the reaction to that news is. But when Powell speaks, T-shirt for Trader has a shirt that pretty much sums it up. Good morning, Dan the man, just letting the team know that I will be standing down until the FOMC report comes out at 2, and then Powell speaks at 2:30. Typically, once the FOMC report comes out at 2, you'll have a move, and then when Powell starts speaking, you'll have another move. So with that being the case, I'm going to stand down this morning. I will keep the chart up, but I will be standing down. Following the lead of people who are more professional than I am currently. And they are waiting for the FOMC report and seeing how the market will respond to that. Matthew said FOMO on that one day DTE call. I was floating yesterday afternoon. My goodness. Well, I mean, look what happened yesterday afternoon. I mean, it had a drop from the 543. Okay. All right. From the 543 to the 537. Okay. This is a $5 drop at the end of the day. Bananas. A $5 drop to a $10 gap. So this is absolutely, the best time to be standing aside. And I am grateful that I am on the sidelines. I will not be trading this morning until 2 o'clock. I will keep the charts up. I will observe, but I will not participate until after I see how the market has decided upon receiving the FOMC information. I'm in absolutely no hurry. I have nothing but time. It's part of our profession. We have to know and understand these events, learn these events, and then learn how to trade these events. My first FOMC I traded this year, I got wrecked. My second one is pretty decent, but it all comes with waiting until the reaction. So guys, I will be in the background, but I will not be active on the mic until 2 o'clock. Thank you for tuning in. Choose to stay with us. That would be awesome sauce. Very nice, quiet morning. We'll be observing. We will be observing. In fact, I'm not going to even draw any algos right now. I'm going to allow this time for you guys to practice drawing them yourselves. And then when I come back, we'll see how everyone did. I'm going to go ahead and change the vibe right now to some thinking music, just so we don't disturb anybody who chooses to keep the channel up. Anybody still on here? Anybody still on the line? I got a question I want to ask. I just want to take a general consensus. Anybody still on here? Got a quick question for the team, being that we're going to be waiting today for FOMC here on the channel. I can either keep this thinking music on so that nobody is disturbed, or I can cut on an audio trading book. This way, for those of you who wouldn't be disturbed, we can cut on an audio trading book and take this opportunity to expand our learning. So, let me know what you think in chat. The book I'm thinking about putting on is Trading for a Living by Alexander L. I was saying, Dan, what I thought about doing, being that I'm not going to trade until 2 o'clock, rather than just sit here and listen to this thinking music, I could either do that or I could put on a trading audio book. I thought about putting on a trading audio book just to switch it up. Just wondered, what you guys would think about that, or if you think that'd be too much, or just leave the thinking music on. So that's what I just want to get an opinion on that. Audio book would be good. All right, awesome. That also helped the time go by and expand our thinking as well. All righty. Give me a minute while I get everything tuned up.
Risking their own money. They seldom do well trading for their own. Words of a former U.S. president, an evil empire. I hated the Soviet system and wanted to get out, but immigration was forbidden. I entered college at 16, graduated medical school at 22, completed my residency, and then took a job as a ship's doctor. Now I could break free. I jumped the Soviet ship in Abidjan, Ivory Coast. I ran to the U.S. Embassy through the clogged, dusty streets of an African port city, chased by my ex-crewmates. The bureaucrats at the embassy fumbled and almost handed me back to the Soviets. I resisted, and they put me in a safe house and then on a plane to New York. I landed at Kennedy Airport in February 1974, arriving from Africa with summer clothes on my back and $25 in my pocket. I spoke some English, but did not know a soul in this country. I had no idea what stocks, bonds, futures, or options were, and sometimes got a queasy feeling just from looking at the American dollar bills in my wallet. In the old country, a handful of them could buy you 3 years in Siberia. Reading how to buy stocks opened a whole new world for me. Returning to New York, I bought my first stock. It was KinderCare. Ever since then, I have avidly studied the markets and invested and traded stocks, options, and now mostly futures. My professional career proceeded on a separate track. I completed a residency in psychiatry at a major university hospital, studied at the New York Psychoanalytic Institute, and served as book editor for the largest psychiatric newspaper in the United States. These days, I am busy trading and go to my psychiatric office across the street from Carnegie Hall only a few afternoons a week after the markets close. I love practicing psychiatry, but I spend most of my time in the markets. Learning to trade has been a long journey, with soaring highs and aching lows. In moving forward or in circles, I repeatedly knocked my face against the wall and ran my trading account into the ground. Each time I returned to a hospital job, put a stake together, read, thought, did more testing, and then started trading again. My trading slowly improved, but the breakthrough came when I realized that the key to winning was inside my head and not inside a computer. Psychiatry gave me the insight into trading that I will share with you. Psychology is the key. You may base your trades on fundamental or technical analysis. You may trade because of hunches about economic or political trends, use inside information, or simply hope. Remember how you felt the last time you placed an order? Were you anxious to jump in or afraid of losing? Did you procrastinate before picking up the phone? When you closed out a trade, did you feel elated or humiliated? The feelings of thousands of traders merge into huge psychological tides that move the markets. The majority of traders spend most of their time looking for good trades. Once they enter a trade, they lose control and either squirm from pain or grin from pleasure. They ride an emotional roller coaster and miss the essential element of winning, the management of their emotions. Their inability to manage themselves leads to poor money management of their accounts. If your mind is not in gear with the markets, or if you ignore changes in mass psychology of crowds, then you have no chance of making money trading. All winning professionals know the enormous importance of psychology in trading. All losing amateurs ignore it. Friends and clients who know that I am a psychiatrist often ask me whether this helps me as a trader. Good psychiatry and good trading have one important principle in common. Both focus on reality, on seeing the world the way it is. To live a healthy life, you have to live with your eyes open. To be a good trader, you need to trade with your eyes open, recognize real trends and turns, and not waste time or energy on regrets and wishful thinking. Why do most traders lose and wash out of the markets? Emotional and thoughtless trading are two reasons, but there is another. Markets are actually set up so that most traders must lose money. The trading industry kills traders with commissions and slippage. Most amateurs cannot believe this, just as medieval peasants could not believe that tiny invisible germs could kill them. If you ignore slippage and deal with a broker who charges high commissions, you are acting like a peasant who drinks from a communal pool during a cholera epidemic. You pay commissions for entering and exiting trades. Slippage is the difference between the price at which you place your order and the price at which it gets filled. When you place a limit order, it is filled at your price or not at all. When you feel eager to enter or exit the market and give a market order, it is often filled at a worse price than prevailed when you placed it. The trading industry keeps draining huge amounts of money from the markets. Exchanges, regulators, brokers, and advisors live off the markets while generations of traders keep washing out. Markets need a fresh supply of losers, just as builders of the ancient pyramids of Egypt needed a fresh supply of slaves. Losers bring money into the markets, which is necessary for the prosperity of the trading industry. Brokers, exchanges, and advisors run marketing campaigns to attract more losers to the markets. Some mention that futures trading is a zero-sum game. They count on the fact that most people feel smarter than average and expect to win in a zero-sum game. Winners in a zero-sum game make as much as losers lose. If you and I bet $10 on the direction of the next 100-point move in the Dow, one of us will collect $10 and the other will lose $10. The person who is smarter should win this game over a period of time. People buy the trading industry's propaganda about the zero-sum game, take the bait, and open trading accounts. They do not realize that trading is a minus-sum game. Winners receive less than what losers lose because the industry drains money from the market. For example, roulette in a casino is a minus-sum game because the casino sweeps away 3% to 6% of all bets. This makes roulette unwinnable in the long run. You and I can get into a minus-sum game if we make the same $10 bet on the next 100-point move in the Dow, but deal through brokers. When we settle, the loser is out $13 and the winner collects only $7, while two brokers smile all the way to the bank. Commissions and slippage are to traders what death and taxes are to all of us. They take some fun out of life and ultimately bring it to an end. A trader must support his broker and the machinery of exchanges before he collects a dime. Being simply better than average is not good enough. You have to be head and shoulders above the crowd to win a minus-sum game. You can expect to pay a round-trip commission of anywhere from $12 to $100 for every futures contract you trade. Big traders who deal with discount houses pay less. Small traders who deal with full-service brokers pay more. Amateurs ignore commissions while dreaming of fat profits. Brokers argue that commissions are tiny relative to the value of underlying contracts. To understand the role of commissions, you need to compare them to your margin, not to the value of the contract. For example, you may pay $30 to trade a single contract of corn, 5,000 bushels worth approximately $10,000. A broker will say that the $30 commission is less than 1% of contract value. In reality, you have to deposit about $600 to trade a contract of corn. A $30 commission represents 5% of margin. This means you have to make 5% on the capital committed to the trade simply to break even. If you trade corn 4 times a year, you will have to make a 20% annual profit to avoid losing money. Very few people can do this. Many money managers would give their eye teeth for 20% annual returns. A small commission is not a nuisance. It is a major barrier to success. Many amateurs generate 50% and more of their account size in commissions per year, if they last that long. Even discounted commissions raise a tall barrier to successful trading. I have heard brokers chuckle as they gossiped about clients who beat their brains out just to stay even with the game. Shop for the lowest possible commissions. Do not be shy about bargaining for lower rates. I have heard many brokers complain about a shortage of customers, but not many customers complain about the shortage of brokers. Tell your broker it is in his best interest to charge you low commissions because you will survive and remain a client for a long time. Design a trading system that will trade less often. Slippage takes either piranha-sized or shark-sized bites out of your account whenever you enter and exit the markets. Slippage means having your orders filled at a different price than that which existed when you placed an order. It is like paying 30 cents for an apple in a grocery store, even though the posted price is 29 cents. There are 3 kinds of slippage: common, volatility-based, and criminal. Common slippage is due to a spread between buying and selling prices. Floor traders maintain two prices in the market, the bid and the ask. For example, your broker may quote you 390.45 for June S&P 500. If you want to buy a contract at the market, you'll have to pay at least 390.50. If you want to sell at the market, you will receive 390.40 or less. Since each point is worth $5, the 10-point spread between bid and ask transfers $50 from your pocket to floor traders. They charge you for the privilege of entering or exiting a trade. The spread between bid and ask is legal. It tends to be narrow in big liquid markets such as the S&P 500 and bonds, and much wider in thinly traded markets such as orange juice and cocoa. The exchanges claim that the spread is the price you pay for liquidity, being able to trade whenever you wish. Electronic trading promises to cut slippage. Slippage rises with market volatility. Floor traders can get away with more in fast-moving markets. When the market begins to run, slippage goes through the roof. When the S&P 500 rallies or drops, you can get hit with a 20 to 30 point slippage and sometimes 100 points or more. The third kind of slippage is caused by criminal activities of floor traders. They have many ways of stealing money from customers. Some put their bad trades into your account and keep good trades for themselves. This kind of activity and other criminal games were recently described in a book, Brokers, Bagmen, and Moles, by David Greising and Laurie Morse. When 100 men spend day after day standing shoulder to shoulder in a small pit, they develop a camaraderie, an us-against-them mentality. Floor traders have a nickname for outsiders which shows that they consider us less than human. They call us paper, as in, is paper coming in today? That is why you have to take steps to protect yourself. To reduce slippage, trade liquid markets and avoid thin and fast-moving markets. Go long or short when the market is quiet. Use limit orders. Buy or sell at a specified price. Keep a record of prices at the time when you placed your order and have your broker fight the floor on your behalf when necessary. Slippage and commissions make trading similar to swimming in a shark-infested lagoon. Let us compare an example from a broker's sales pitch to what happens in the real world. The party line goes like this. A contract of gold futures covers 100 ounces of gold. 5 individuals buy a contract each from someone who sells 5 contracts short. Gold falls $4, and the buyers bail out, losing $4 per ounce or $400 per contract. The intelligent trader, who sold 5 contracts short, covers his position and makes $400 per contract for a total of $2,000. In the real world, however, each loser has lost more than $400. He paid at least a $25 round-trip commission and was probably hit with $20 slippage coming and going. As a result, each loser lost $465 per contract, and as a group, they lost $2,325. The winner, who sold 5 contracts short, probably paid a $15 round-trip commission and was hit with $10 slippage coming and going, reducing his gain by $35 per contract or $175 for 5 contracts. He pocketed only $1,825. The winner thought he made $2,000, but he received only $1,825. The losers thought they lost $2,000, but in fact they lost $2,325. In total, fully $500, $2,325 minus $1,825, was siphoned from the table. The lion's share was pocketed by floor traders and brokers who took a much bigger cut than any casino or a racetrack would dare. Other expenses also drained traders' money. The cost of computers and data, fees for advisory services and books, including the one you are reading now, all come out of your trading funds. Look for a broker with the cheapest commissions and watch him like a hawk. Design a trading system that gives signals relatively infrequently and allows you to enter markets during quiet times. Individual psychology. Trading appears deceptively easy. When a beginner wins, he feels brilliant and invincible. Then he takes wild risks and loses everything. People trade for many reasons, some rational and many irrational. Trading offers an opportunity to make a lot of money in a hurry. Money symbolizes freedom to many people, even though they often do not know what to do with their freedom. If you know how to trade, you can make your own hours, live and work wherever you please, and never answer to a boss. Trading is a fascinating intellectual pursuit. Chess, poker, and a crossword rolled into one. Trading attracts people who love puzzles and brain teasers. Trading attracts risk-takers and repels those who avoid risk. An average person gets up in the morning, goes to work, has a lunch break, returns home, has a beer and dinner, watches TV, and goes to sleep. If he makes a few extra dollars, he puts them into a savings account. A trader keeps odd hours and puts his capital at risk. Many traders are loners who abandon the certainty of the present and take a leap into the unknown. Most people have an innate drive to achieve their personal best, to develop their abilities to the fullest. This drive, along with the pleasure of the game and the lure of money, propels traders to challenge the markets. Good traders tend to be hardworking and shrewd. They are open to new ideas. The goal of a good trader, paradoxically, is not to make money. His goal is to trade well. If he trades right, money follows almost as an afterthought. Successful traders keep honing their skills. Trying to reach their personal best is more important to them than making money. A successful New York trader said to me, "If I become 0.5% smarter each year, I'll be a genius by the time I die." His drive to improve himself is the hallmark of a successful trader. A professional trader from Texas invited me to his office and said, "If you sit across the table from me while I day trade, you won't be able to tell whether I am $2,000 ahead or $2,000 behind on that day." He has risen to a level where winning does not elate him and losing does not deflate him. He is so focused on trading right and improving his skills that money no longer influences his emotions. The trouble with self-fulfillment is that many people have a self-destructive streak. Accident-prone drivers keep destroying their cars, and self-destructive traders keep destroying their accounts. Markets offer unlimited opportunities for self-sabotage, as well as for self-fulfillment. Acting out your internal conflicts in the marketplace is a very expensive proposition. Traders who are not at peace with themselves often try to fulfill their contradictory wishes in the market. If you do not know where you are going, you will wind up somewhere you never wanted to be. Trading psychology. Your feelings have an immediate impact on your account equity. You may have a brilliant trading system, but if you feel frightened, arrogant, or upset, your account is sure to suffer. When you recognize that a gambler's high or fear is clouding your mind, stop trading. Your success or failure as a trader depends on controlling your emotions. When you trade, you compete against the sharpest minds in the world. The field on which you compete has been slanted to ensure your failure. If you allow your emotions to interfere with your trading, the battle is over. You are responsible for every trade that you make. A trade begins when you decide to enter the market and ends only when you decide to take yourself out. Having a good trading system is not enough. Most traders with good systems wash out of the markets because psychologically they are not prepared to win. Markets offer enormous temptations, like walking through a gold vault or through a harem. Markets evoke powerful greed for more gains and a great fear of losing what we've got. Those feelings cloud our perceptions of opportunities and dangers. Most amateurs feel like geniuses after a winning streak. It is exciting to believe that you are so good you can bend your own rules and succeed. That's when traders deviate from their rules and go into a self-destruct mode. Traders gain some knowledge, they win, their emotions kick in, and they self-destruct. Most traders promptly give their killings back to the markets. The markets are full of rags to riches to rags stories. The hallmark of a successful trader is his ability to accumulate equity. You need to make trading as objective as possible. Keep a diary of all your trades with before and after charts. Keep a spreadsheet listing all your trades, including commissions and slippage, and maintain very strict money management rules. You may have to devote as much energy to analyzing yourself as you do to analyzing the markets. When I was learning how to trade, I read every book on trading psychology I could find. Many writers offered sensible advice. Some stressed discipline. You cannot let the market sway you. Do not make decisions during trading hours. Plan a trade and trade a plan. Others stressed flexibility. Do not enter the market with any preconceived notions. Change your plans when markets change. Some experts suggested isolation. No business news, no Wall Street Journal, no listening to other traders, just you and the markets. Others advised being open-minded, keeping in touch with other traders, and soaking up fresh ideas. Each piece of advice seemed to make sense, but contradicted other equally sensible advice. As a trader, you are in the business of trading. You need to define your businessman's risk, the maximum amount of money you will risk on any single trade. There is no standard dollar amount, just as there is no standard business. An acceptable businessman's risk depends, first of all, on the size of your trading account. It also depends on your trading method and pain tolerance. The concept of a businessman's risk will change the way you manage your money. A sensible trader never risks more than 2% of account equity on any trade. For example, if you have $30,000 in your account, you may not risk more than $600 per trade, and if you have $10,000, you may not risk more than $200. If your account is small, limit yourself to trading less expensive markets or mini contracts. If you see an attractive trade but your stop would have to be placed where more than 2% of equity would be at risk, pass that trade. Avoid risking more than 2% on a trade the way a recovering alcoholic avoids bars. If you are not sure how much to risk, err on the side of caution. If you blame excess commissions on a broker and slippage on a floor trader, you give up control of your trading life. Try to reduce both, but take responsibility for them. If you lose even $1 more than your businessman's risk, including commissions and slippage, you are a loser. Do you keep good trading records? Poor record keeping is a sure sign of a gambler and a loser. Good businessmen keep good records. Your trading records must show the date and price of every entry and exit, slippage, commissions, stops, all adjustments of stops, reasons for entering, objectives for exiting, maximum paper profit, maximum paper loss after a stop was hit, and any other necessary data. If you bail out of a trade within your businessman's risk, it is normal business. There is no bargaining, no waiting for another tick, no hoping for a change. Losing $1 more than your established businessman's risk is like getting drunk, getting into a brawl, getting sick to your stomach on your way home, and waking up in the gutter with a headache. You would never want that to happen. Each trader has his own demons to exorcise on the journey to becoming a successful professional. Here are several rules that worked for me as I grew from a wild amateur into an erratic semi-professional, and finally into a professional trader. You may change this list to suit your personality. 1. Decide that you are in the market for the long haul. That is, you want to be a trader even 20 years from now. 2. Learn as much as you can. Read and listen to experts, but keep a degree of healthy skepticism about everything. Ask questions and do not accept experts at their word. 3. Do not get greedy and rush to trade. Take your time to learn. The markets will be there with more good opportunities in the months and years ahead. 4. Develop a method for analyzing the market. That is, if A happens, then B is likely to happen. The markets have many dimensions. Use several analytic methods to confirm trades. Test everything on historical data, and then in the markets using real money. Markets keep changing. You need different tools for trading bull and bear markets and transitional periods, as well as a method for telling the difference. 5. Develop a money management plan. Your first goal must be long-term survival. Your second goal, a steady growth of capital. And your third goal, making high profits. Most traders put the third goal first and are unaware that goals 1 and 2 exist. 6. Be aware that a trader is the weakest link in any trading system. Go to a meeting of Alcoholics Anonymous to learn how to avoid losses or develop your own method for cutting out impulsive trades. 7. Winners think, feel, and act differently than losers. You must look within yourself, strip away your illusions, and change your old ways of being, thinking, and acting. Change is hard, but if you want to be a professional trader, you have to work on changing your personality. Mass psychology. Wall Street is named after a wall that kept farm animals from wandering away from the settlement at the tip of Manhattan. The farming legacy lives on in the language of traders. 4 animals are mentioned especially often on Wall Street: bulls and bears, hogs and sheep. Traders say, bulls make money, bears make money, but hogs get slaughtered. A bull fights by striking up with his horns. A bull is a buyer, a person who bets on a rally and profits from a rise in prices. A bear fights by striking down with his paws. A bear is a seller, a person who bets on a decline and profits from a fall in prices. Hogs are greedy. They get slaughtered when they trade to satisfy their greed. Some hogs buy or sell positions that are too large for them and get destroyed by a small adverse move. Other hogs overstay their positions. They keep waiting for profits to get bigger even after the trend reverses. Sheep are passive and fearful followers of trends, tips, and gurus. They sometimes put on a bull's horns or a bearskin and try to swagger. You recognize them by their pitiful bleating when the market becomes volatile. Whenever the market is open, bulls are buying, bears are selling, hogs and sheep get trampled underfoot, and the undecided traders wait on the sidelines. Quote machines all over the world show a steady stream of quotes, the latest prices for any trading vehicle. Thousands of eyes are focused on each price quote as people make trading decisions. There are 3 groups of traders in the market: buyers, sellers, and undecided traders. Ask is what a seller asks for his merchandise. Bid is what a buyer offers for that merchandise. Buyers and sellers are always in conflict. Buyers want to pay as little as possible, and sellers want to charge as much as possible. If members of both groups insist on having their way, no trade can take place. No trade means no price, only wishful quotes of buyers and sellers. A seller has a choice: to wait until prices rise or to accept a lower offer for his merchandise. A buyer also has a choice: to wait until prices come down or to offer to pay more to the sellers. A trade occurs when there is a momentary meeting of two minds. An eager bull agrees to a seller's terms and pays up, or an eager bear agrees to a buyer's terms and sells a little cheaper. The presence of undecided traders puts pressure on both bulls and bears. When a buyer and a seller bargain in private, they may haggle at a leisurely pace. The two must move much faster when they bargain at the exchange. They know that they are surrounded by a crowd of other traders who may butt in on their deal at any moment. The buyer knows that if he thinks for too long, another trader can step in and snap away his bargain. A seller knows that if he tries to hold out for a higher price, another trader may step in and sell at a lower price. The crowd of undecided traders makes buyers and sellers more anxious to accommodate their opponents. A trade occurs when there is a meeting of two minds. Each tick on your quote screen represents a deal between a buyer and a seller. Buyers are buying because they expect prices to rise. Sellers are selling because they expect prices to fall. Buyers and sellers trade while surrounded by crowds of undecided traders. They may become buyers or sellers as prices change or as time passes. Buying by bulls pushes markets up. Selling by bears pushes markets down, and undecided traders make everything happen faster by creating a sense of urgency in buyers and sellers. Traders come to the markets from all over the world, in person, via computers, or through their brokers. Everybody has a chance to buy and to sell. Each price is a momentary consensus of value of all market participants expressed in action. Price is a psychological event, a momentary balance of opinion between bulls and bears. Prices are created by masses of traders, buyers, sellers, and undecided people. The patterns of prices and volume reflect the mass psychology of the markets. Huge crowds converge on stock, commodity, and option exchanges, either in person or represented by their brokers. Big money and little money, smart money and dumb money, institutional money and private money all meet on the exchange floor. Each price represents a momentary consensus of value between buyers, sellers, and undecided traders at the moment of transaction. There is a crowd of traders behind every pattern in the chart book. Crowd consensus changes from moment to moment. Sometimes it gets established in a very low-key environment, and at other times, the environment turns wild. Prices move in small increments during quiet times. When a crowd becomes either spooked or elated, prices begin to jump. Imagine bidding for a life preserver aboard a sinking ship. That's how prices leap when masses of traders become emotional about a trend. An astute trader tries to enter the market during quiet times and take profits during wild times. Technical analysts study swings of mass psychology in the financial markets. Each trading session is a battle between bulls, who make money when prices rise, and bears, who profit when prices fall. The goal of technical analysts is to discover the balance of power between bulls and bears and bet on the winning group. If bulls are much stronger, you should buy and hold. If bears are much stronger, you should sell and sell short. If both camps are about equal in strength, a wise trader stands aside. He lets bullies fight with each other and puts on a trade only when he is reasonably sure who is likely to win. Prices, volume, and open interest reflect crowd behavior. So do the indicators that are based on them. This makes technical analysis similar to poll taking. Both combine science and art. They are scientific to the extent that we use statistical methods in computers. They are artistic to the extent that we use personal judgment to interpret our findings. What is the reality behind market symbols, prices, numbers, and graphs? When you check prices in your newspaper, watch quotes on your screen, or plot an indicator on your chart, what exactly are you looking at? What is the market that you want to analyze and trade? Amateurs act as if the market is a giant happening, a ball game in which they can join the professionals and make money. Traders from a scientific or engineering background often treat the market as a physical event. They apply to it the principles of signal processing, noise reduction, and similar ideas. By contrast, all professional traders know full well what the market is. It is a huge mass of people. Every trader tries to take money away from other traders by outguessing them on the probable direction of the market. The members of the market crowd live on different continents. They are united by modern telecommunications in the pursuit of profit at each other's expense. The market is a huge crowd of people. Each member of the crowd tries to take money away from other members by outsmarting them. The market is a uniquely harsh environment because everyone is against you and you are against everyone. Not only is the market harsh, you have to pay high prices for entering and exiting it. You have to jump over 2 high barriers, commissions and slippage, before you can collect a dime. The moment you place an order, you owe your broker a commission. You are behind the game before you begin. Then floor traders try to hit you with slippage when your order arrives on the floor. They try to take another bite out of your account when you exit your trade. In trading, you compete against some of the brightest minds in the world while fending off the piranhas of commissions and slippage. Private traders usually come to the market after a successful career in business or in the professions. An average private futures trader in the United States is a 50-year-old, married, college-educated man. Many futures traders own their own businesses, and many have postgraduate degrees. The 2 largest occupational groups among futures traders are farmers and engineers. Most people trade for partly rational, partly irrational reasons. Rational reasons include the desire to earn a large return on capital. Irrational reasons include gambling and a search for excitement. Most traders are not aware of their irrational motives. Learning to trade takes hard work, time, energy, and money. Few individuals rise to the level of professionals who can support themselves by trading. Professionals are extremely serious about what they do. They satisfy their irrational goals outside the markets, while amateurs act them out in the marketplace. The major economic role of a trader is to support his broker, to help him pay his mortgage and keep his children in private schools. In addition, the role of a speculator is to help companies raise capital in the stock market and to assume a price risk in the commodities markets, allowing producers to focus on production. These lofty economic goals are far from a speculator's mind when he gives an order to his broker. Institutions are responsible for a huge volume of trading. Their deep pockets give them several advantages. They pay low institutional commissions. They can afford to hire the best researchers, brokers, and traders. Some even strike back at floor traders who steal too much in slippage. The spate of arrests and trials of Chicago floor traders in 1990 and 1991 began when Archer Daniels Midland, a food processing firm, brought in the FBI. A friend of mine who heads a trading desk at a bank bases some of his decisions on a service provided by a group of former CIA officers. They scan the media to detect early trends in society and send their reports to him. My trader friend culls some of his best ideas from these reports. The substantial annual fee for those experts is small potatoes for his firm compared with the millions of dollars it trades. Most private traders do not have such opportunities. It is easier for institutions to buy the best research. An acquaintance who used to trade successfully for a Wall Street investment bank found himself in trouble when he quit to trade for himself. He discovered that a real-time quote system in his Park Avenue apartment in Manhattan did not give him news as fast as the squawk box on the trading floor of his old firm. Brokers from around the country used to call him with the latest ideas because they wanted his orders. When you trade from your house, you are never the first to hear the news, he says. Some large firms have intelligence networks that enable them to act before the public. One day, when oil futures rallied in response to a fire on a platform in the North Sea, I called a friend at an oil firm. The market was frantic, but he was relaxed. He had bought oil futures half an hour before they exploded. He had gotten a telex from an agent in the area of the fire well before the reports appeared on the newswire. Timely information is priceless, but only a large company can afford an intelligence network. The firms that deal in both futures and cash markets have two advantages. They have true inside information, and they are exempt from speculative position limits. Recently, I visited an acquaintance at a multinational oil company. After passing through security that was tighter than at Kennedy International Airport, I walked through glass-enclosed corridors. Clusters of men huddled around monitors trading oil products. When I asked my host whether his traders were hedging or speculating, he looked me straight in the eye and said, "Yes." I asked again and received the same answer. Companies crisscross the thin line between hedging and speculating based on inside information. Employees of trading firms have a psychological advantage. They can be more relaxed because their own money is not at risk. Most individuals do not have the discipline to stop trading when they get on a losing streak, but institutions impose discipline on traders. A trader is given two limits: how much he may risk on a single trade, and the maximum amount he may lose in a month. These limits work as stop-loss orders on a trader. With all these advantages, how can an individual trader compete against institutions and win? First, many institutional trading departments are poorly run. Second, the Achilles heel of most institutions is that they often have to trade, while an individual trader is free to trade or stay out of the market. Banks have to be active in the bond market, and food processing companies have to be active in the grain market at almost any price. An individual trader is free to wait for the best trading opportunities. Most private traders fritter away this advantage by overtrading. An individual who wants to succeed against the giants must develop patience and eliminate greed. Remember, your goal is to trade well, not to trade often. Successful institutional traders receive raises and bonuses. Even a high bonus can feel puny to someone who earns many millions of dollars for his firm. Successful institutional traders often talk of quitting and going to trade for themselves. Most traders who leave institutions get caught up in the emotions of fear, greed, elation, and panic when they start risking their own money. They seldom do well trading for their own account. Another sign that psychology is at the root of trading success or failure. The market crowd and you. The market is a loosely organized crowd whose members bet that prices will rise or fall. Since each price represents the consensus of the crowd at the moment of transaction, all traders are in effect betting on the future mood of the crowd. That crowd keeps swinging from indifference to optimism or pessimism, and from hope to fear. Most people do not follow their own trading plans because they let the crowd influence their feelings, thoughts, and actions. Bulls and bears battle in the market, and the value of your investment sinks or soars depending on the actions of total strangers. You cannot control the markets. You can only decide whether and when to enter or exit trades. Most traders feel jittery when we enter a trade. Their judgment becomes clouded by emotions after they join the market crowd. These crowd-induced emotions make traders deviate from their trading plans and lose money. Charles Mackay, a Scottish barrister, wrote his classic book, Extraordinary Popular Delusions and the Madness of Crowds, in 1841. He described several mass manias, including the tulip mania in Holland in 1634 and the South Seas investment bubble in England in 1720. The tulip craze began as a bull market in tulip bulbs. The long bull market convinced the prosperous Dutch that tulips would continue to appreciate. Many of them abandoned their businesses to grow tulips, trade them, or become tulip brokers. Banks accepted tulips as collateral and speculators profited. Finally, that mania collapsed in waves of panic selling, leaving many people destitute and the nation shocked. Mackay sighed. Men go mad in crowds, and they come back to their senses slowly and one by one. In 1897, Gustave Le Bon, a French philosopher and politician, wrote The Crowd, one of the best books on mass psychology. A trader who reads it today can see his reflection in a century-old mirror. Le Bon wrote that when people gather in a crowd, whoever be the individuals that compose it, however like or unlike be their mode of life, their occupations, their character, or their intelligence, the fact that they have been transformed into a crowd puts them in possession of a sort of collective mind which makes them feel, think, and act in a manner quite different from that in which each individual of them would feel, think, and act were he in a state of isolation. People change when they join crowds. They become more credulous and impulsive, anxiously search for a leader, and react to emotions instead of using their intellect. An individual who becomes involved in a group becomes less capable of thinking for himself. You need to base your trades on a carefully prepared trading plan and not jump in response to price changes. It pays to write down your plan. You need to know exactly under what conditions you will enter and exit a trade. Do not make decisions on the spur of the moment, when you are vulnerable to being sucked into the crowd. You can succeed in trading only when you think and act as an individual. The weakest part of any trading system is the trader himself. Traders fail when they trade without a plan or deviate from their plans. Plans are created by reasoning individuals. Impulsive trades are made by sweaty group members. You have to observe yourself and notice changes in your mental state as you trade. Write down your reasons for entering a trade and the rules for getting out of it, including money management rules. You must not change your plan while you have an open position. Sirens were sea creatures of Greek myths who sang so beautifully that sailors jumped overboard and drowned. When Odysseus wanted to hear the sirens' songs, he ordered his men to tie him to the mast and to put wax in their own ears. Odysseus heard the sirens' songs, but survived because he could not jump. You ensure your survival as a trader when on a clear day you tie yourself to the mast of a trading plan and money management rules. Psychology of trends. Each price is the momentary consensus of value of all market participants. It shows their latest vote on the value of a trading vehicle. Any trader can put in his 2 cents worth by giving an order to buy or to sell or by refusing to trade at the current level. Each bar on a chart reflects the battle between bulls and bears. When bulls feel strongly bullish, they buy more eagerly and push markets up. When bears feel strongly bearish, they sell more actively and push markets down. Each price reflects action or lack of action by all traders in the market. Charts are a window into mass psychology. When you analyze charts, you analyze the behavior of traders. Technical indicators help make this analysis more objective. Technical analysis is applied social psychology. It aims to recognize trends and changes in crowd behavior in order to make intelligent trading decisions. Ask most traders why prices went up, and you are likely to get a stock answer. More buyers than sellers. This is not true. The number of trading instruments, such as stocks or futures, bought and sold in any market is always equal. If you want to buy a contract of Swiss francs, someone has to sell it to you. If you want to sell short a contract of the S&P 500, someone has to buy it from you. The number of stocks bought and sold is equal in the stock market. Furthermore, the number of long and short positions in the futures markets is always equal. Prices move up or down because of changes in the intensity of greed and fear among buyers or sellers. When the trend is up, bulls feel optimistic and do not mind paying a little extra. They buy high because they expect prices to rise even higher. Bears feel tense in an uptrend, and they agree to sell only at a higher price. When greedy and optimistic bulls meet fearful and defensive bears, the market rallies. The stronger their feelings, the sharper the rally. The rally ends only when many bulls lose their enthusiasm. When prices slide, bears feel optimistic and do not quibble about selling short at lower prices. Bulls are fearful and agree to buy only at a discount. As long as bears feel like winners, they continue to sell at lower prices and the downtrend continues. It ends when bears start feeling cautious and refuse to sell at lower prices. Few traders act as purely rational human beings. There is a great deal of emotional activity in the markets. Most market participants act on the principle of monkey see, monkey do. The waves of fear and greed sweep up bulls and bears. Markets rise because of greed among buyers and fear among short sellers. Bulls normally like to buy on the cheap. When they turn very bullish, they become more concerned with not missing the rally than with getting a cheap price. A rally continues as long as bulls are greedy enough to meet sellers' demands. The sharpness of a rally depends on how traders feel. If buyers feel just a little stronger than sellers, the market rises slowly. When they feel much stronger than sellers, the market rises fast. It is the job of a technical analyst to find when buyers are strong and when they start running out of steam. Short sellers feel trapped by rising markets as their profits melt and turn into losses. When short sellers rush to cover, a rally becomes nearly vertical. Fear is a stronger emotion than greed, and rallies driven by short covering are especially sharp. Markets fall because of greed among bears and fear among bulls. Normally, bears prefer to sell short on rallies, but if they expect to make a lot of money on a decline, they don't mind shorting on the way down. Fearful buyers agree to buy only below the market. As long as short sellers are willing to meet those demands and sell at a bid, the decline continues. As bulls' profits melt and turn into losses, they panic and sell at almost any price. They are so eager to get out that they hit the bids under the market. Markets can fall very fast when hit by panic selling. Buying by happy bulls and covering by fearful bears pushes uptrends higher. Buyers feel rewarded while sellers feel punished. Both feel emotionally involved, but few traders realize that they are creating the uptrend, creating their own leader. Eventually, a price shock occurs. A major sale hits the market, and there are not enough buyers to absorb it. The uptrend takes a dive. Bulls feel mistreated, like children whose father hit them with a strap during a meal. But bears feel encouraged. A price shock plants the seeds of an uptrend's reversal. Even if the market recovers and reaches a new high, bulls feel more skittish and bears become bolder. This lack of cohesion in the dominant group and optimism among its opponents makes the uptrend ready to reverse. Several technical indicators identify tops by tracing a pattern called bearish divergence. It occurs when prices reach a new high, but the indicator reaches a lower high than it did on a previous rally. Bearish divergences mark the best shorting opportunities. When the trend is down, bears feel like good children, praised and rewarded for being smart. They feel increasingly confident, add to their positions, and the downtrend continues. New bears come into the market. Most people admire winners, and the financial media keep interviewing bears in bear markets. Bulls lose money in downtrends, and that makes them feel bad. Bulls dump their positions, and many switch sides to join bears. Their selling pushes markets lower. After a while, bears grow confident and bulls feel demoralized. Suddenly, a price shock occurs. A cluster of buy orders soaks up all available sell orders and lifts the market. Now bears feel like children whose father has lashed out at them in the midst of a happy meal. A price shock plants the seeds of a downtrend's eventual reversal because bears become more fearful and bulls grow bolder. When a child begins to doubt that Santa Claus exists, he seldom believes in Santa again. Even if bears recover and prices fall to a new low, several technical indicators identify their weakness by tracing a pattern called a bullish divergence. It occurs when prices fall to a new low, but an indicator traces a more shallow bottom than during the previous decline. An individual has a free will, and his behavior is hard to predict. Group behavior is more primitive and easier to follow. When you analyze markets, you analyze group behavior. You need to identify the direction in which groups run and their changes. Groups suck us in and cloud our judgment. The problem for most analysts is that they get caught in the mentality of the groups they analyze. The longer a rally continues, the more technicians get caught up in bullish sentiment, ignore the danger signs, and miss the reversal. The longer a decline goes on, the more technicians get caught up in bearish gloom and ignore bullish signs. This is why it helps to have a written plan for analyzing the markets. We have to decide in advance what indicators we will watch and how we will interpret them. Floor traders use several tools for tracking the quality and intensity of a crowd's feelings. They watch the crowd's ability to break through recent support and resistance levels. They keep an eye on the flow of paper, customer orders that come to the floor in response to price changes. Floor traders listen to the changes in pitch and volume of the roar on the exchange floor. If you trade away from the floor, you need other tools for analyzing crowd behavior. Your charts and indicators reflect mass psychology in action. A technical analyst is an applied social psychologist, often armed with a computer. Technical analysts believe that prices reflect everything known about the market, including all fundamental factors. Each price represents the consensus of value of all market participants. Large commercial interests and small speculators, fundamental researchers, technicians, and gamblers. Technical analysis is a study of mass psychology. It is partly a science and partly an art. Technicians use many scientific methods, including mathematical concepts of game theory, probabilities, and so on. Many technicians use computers to track sophisticated indicators. Technical analysis is also an art. The bars on a chart coalesce into patterns and formations. When prices and indicators move, they produce a sense of flow and rhythm. a feeling of tension and beauty that helps you sense what is happening and how to trade. Individual behavior is complex, diverse, and difficult to predict. Group behavior is primitive. Technicians study the behavior patterns of market crowds. They trade when they recognize a pattern that preceded past market moves. A tremendous volume of information pours out of the markets during trading hours. Changes in prices tell us about the battles of bulls and bears. Your job is to analyze this information and bet on the dominant market group. Dramatic forecasts are a marketing gimmick. People who sell advisory services or raise money know that good calls attract paying customers, while bad calls are quickly forgotten. My phone rang while I was writing this chapter. One of the famous gurus, currently down on his luck, told me that he identified a once-in-a-lifetime buying opportunity in a certain agricultural market. He asked me to raise money for him and promised to multiply it 100-fold in 6 months. I do not know how many fools he hooked, but dramatic forecasts have always been good for fleecing the public. Use your common sense when you analyze markets. When some new development puzzles you, compare it to life outside the markets. For example, indicators may give you buy signals in 2 markets. Should you buy the market that declined a lot before the buy signal, or the one that declined a little? Compare this to what happens to a man after a fall. If he falls down a flight of stairs, he may dust himself off and run up again. But if he falls out of a 3rd-story window, he's not going to run anytime soon. He needs time to recover. Prices seldom rally very hard immediately after a bad decline. Successful trading stands on 3 pillars. You need to analyze the balance of power between bulls and bears. You need to practice good money management. You need personal discipline to follow your trading plan and avoid getting high in the markets. Classical chart analysis. Chartists study market action, trying to identify recurrent price patterns. Their goal is to profit from trading when patterns recur. Most chartists work with bar graphs showing high, low, and closing prices and volume. Some also watch opening prices and open interest. Point-and-figure chartists track only price changes and ignore time, volume, and open interest. Classical charting requires only a pencil and paper. It appeals to visually oriented people. Those who plot data by hand often develop a physical feel for prices. Computers speed charting at a cost of losing some of that feel. The biggest problem in charting is wishful thinking. Traders often convince themselves that a pattern is bullish or bearish depending on whether they want to buy or to sell. Chart patterns reflect the tides of greed and fear among traders. This book focuses on daily charts, but you can apply many of its principles to other data. The rules for reading weekly, daily, hourly, or intraday charts are very similar. Each price is a momentary consensus of value of all market participants expressed in action. Each price bar provides several pieces of information about the balance of power between bulls and bears. The opening price of a daily or a weekly bar usually reflects the amateur's opinion of value. They read morning papers, find out what happened the day before, and call their brokers with orders before going to work. Amateurs are especially active early in the day and early in the week. Traders who researched the relationship between opening and closing prices for several decades found that opening prices most often occur near the high or the low of the daily bars. Buying or selling by amateurs early in the day creates an emotional extreme from which prices recoil later in the day. In bull markets, prices often make their low for the week on Monday or Tuesday on profit-taking by amateurs, then rally to a new high on Thursday or Friday. In bear markets, the high for the week is often set on Monday or Tuesday, with a new low toward the end of the week on Thursday or Friday. The closing prices of daily and weekly bars tend to reflect the actions of professional traders. They watch the markets throughout the day, respond to changes, and become especially active near the close. Many of them take profits at that time to avoid carrying trades overnight. Professionals, as a group, usually trade against the amateurs. They tend to buy lower openings, sell short higher openings, and unwind their positions as the day goes on. Traders need to pay attention to the relationship between opening and closing prices. If prices closed higher than they opened, then market professionals were probably more bullish than amateurs. If prices closed lower than they opened, then market professionals were probably more bearish than amateurs. It pays to trade with the professionals and against the amateurs. Efficient markets, random walk, and nature's law. Efficient market theory is an academic notion that nobody can outperform the market because any price at any given moment incorporates all available information. Warren Buffett, one of the most successful investors of our century, commented, "I think it's fascinating how the ruling orthodoxy can cause a lot of people to think the earth is flat. Investing in a market where people believe in efficiency is like playing bridge with someone who's been told it doesn't do any good to look at the cards." The logical flaw of efficient market theory is that it equates knowledge with action. People may have knowledge, but the emotional pull of the crowd often leads them to trade irrationally. A good analyst can detect repetitive patterns of crowd behavior on his charts and exploit them. Random walk theorists claim that market prices change at random. Of course, there is a fair amount of randomness or noise in the markets, just as there is randomness in any other crowd milling around. An intelligent observer can identify repetitive behavior patterns of a crowd and make sensible bets on their continuation or reversal. People have memories. They remember past prices, and their memories influence their buying and selling decisions. Memories help create support under the market and resistance above it. Random walkers deny that memories of the past influence our behavior in the present. As Milton Friedman has pointed out, prices carry information about the availability of supply and the intensity of demand. Market participants use that information to make their buying and selling decisions. For example, consumers buy more merchandise when it is on sale and less when prices are high. Financial traders are just as capable of logical behavior as homemakers in a supermarket. When prices are low, bargain hunters step in. A shortage can lead to a buying panic, but high prices choke off demand. Nature's law is the rallying cry of a clutch of mystics who oppose random walkers in the financial markets. Mystics claim that there is a perfect order in the markets, which they say move like clockwork in response to immutable natural laws. R.N. Elliott even titled his last book, Nature's Law. The perfect order crowd gravitates to astrology and looks for links between prices and the movements of the planets. Most mystics try to hide their astrological bent, but it is easy to draw them out of a shell. Next time someone talks to you about natural order in the markets, ask him about astrology. He will probably jump at the chance to come out of the closet and talk about the stars. Those who believe in perfect order in the markets accept that tops and bottoms can be predicted far into the future. Amateurs love forecasts, and mysticism provides a great marketing gimmick. It helps sell courses, trading systems, and newsletters. Mystics, random walk academics, and efficient market theorists have one trait in common. They are equally divorced from the reality of the markets. Extremists argue with one another, but they think alike. Support and resistance. A ball hits the floor and bounces. It drops after it hits the ceiling. Support and resistance are like a floor and a ceiling, with prices sandwiched between them. Understanding support and resistance is essential for understanding price trends and chart patterns. Rating their strength helps you decide whether the trend is likely to continue or to reverse. Support is a price level where buying is strong enough to interrupt or reverse a downtrend. When a downtrend hits support, it bounces like a diver who hits the bottom and pushes away from it. Support is represented on a chart by a horizontal or near horizontal line connecting several bottoms. Resistance is a price level where selling is strong enough to interrupt or reverse an uptrend. When an uptrend hits resistance, it stops or tumbles down like a man who hits his head on a branch while climbing a tree. Resistance is represented on a chart by a horizontal or near horizontal line connecting several tops. Minor support or resistance causes trends to pause, while major support or resistance causes them to reverse. Traders buy at support and sell at resistance, making their effectiveness a self-fulfilling prophecy. Support and resistance exist because people have memories. Our memories prompt us to buy and sell at certain levels. Buying and selling by crowds of traders creates support and resistance. If traders remember that prices have recently stopped falling and turned up from a certain level, they are likely to buy when prices approach that level again. If traders remember that an uptrend has recently reversed after rising to a certain peak, they tend to sell and go short when prices approach that level again. For example, all major rallies in the stock market from 1966 until 1982 ended whenever the Dow Jones Industrial Average rallied to 950 or 1050. The resistance was so strong that traders named it a graveyard in the sky. Once the bulls rammed the market through that level, it became a major support area. Support and resistance exist because masses of traders feel pain and regret. Traders who hold losing positions feel intense pain. Losers are determined to get out as soon as the market gives them another chance. Traders who missed an opportunity feel regret and also wait for the market to give them a second chance. Feelings of pain and regret are mild in trading ranges where swings are small and losers do not get hurt too badly. Breakouts from trading ranges create intense pain and regret. When the market stays flat for a while, traders get used to buying at the lower edge of the range and shorting at the upper edge. In uptrends, bears who sold short feel pain and bulls feel regret that they did not buy more. Both feel determined to buy if the market gives them a second chance. The pain of bears and regret of bulls make them ready to buy, creating support during reactions in an uptrend. Resistance is an area where bulls feel pain, bears feel regret, and both are ready to sell. When prices break down from a trading range, bulls who bought feel pain, feel trapped, and wait for a rally to let them get out even. Bears regret that they have not shorted more and wait for a rally to give them a second chance to sell short. Bulls' pain and bears' regret create resistance, a ceiling above the market in downtrends. The strength of support and resistance depends on the strength of feelings among masses of traders. A congestion area that has been hit by several trends is like a cratered battlefield. Its defenders have plenty of cover, and an attacking force is likely to slow down. The longer prices stay in a congestion zone, the stronger the emotional commitment of bulls and bears to that area. When prices approach that zone from above, it serves as support. When prices rally into it from below, it acts as resistance. A congestion area can reverse its role and serve as either support or resistance. The strength of every support or resistance zone depends on three factors: its length, its height, and the volume of trading that has taken place in it. You can visualize these factors as the length, the width, and the depth of a congestion zone. The longer a support or resistance area, its length of time or the number of hits it took, the stronger it is. Support and resistance, like good wine, become better with age. A 2-week trading range provides only minimal support or resistance. A 2-month range gives people time to become used to it and creates intermediate support or resistance, while a 2-year range becomes accepted as a standard of value and offers major support or resistance. As support and resistance levels grow old, they gradually become weaker. Losers keep washing out of the markets, replaced by newcomers who do not have the same emotional commitment to old price levels. People who lost money only recently remember full well what happened to them. They are probably still in the market, feeling pain and regret, trying to get even. People who made bad decisions several years ago are probably out of the markets, and their memories matter less. The strength of support and resistance increases each time that area is hit. When traders see that prices have reversed at a certain level, they tend to bet on a reversal the next time prices reach that level. The taller the support and resistance zone, the stronger it is. A tall congestion zone is like a tall fence around a property. A congestion zone whose height equals 1% of current market value, 4 points in the case of the S&P 500 at 400, provides only minor support or resistance. A congestion zone that is 3% tall provides intermediate support or resistance, and a congestion zone that is 7% tall or higher can grind down a major trend. The greater the volume of trading in a support and resistance zone, the stronger it is. High volume in a congestion area shows active involvement by traders, a sign of strong emotional commitment. Low volume shows that traders have little interest in transacting at that level, a sign of weak support or resistance. Trading rules. 1. Whenever the trend you are riding approaches support or resistance, tighten your protective stop. A protective stop is an order to sell below the market when you are long, or to cover shorts above the market when you are short. This stop protects you from getting badly hurt by an adverse market move. A trend reveals its health by how it acts when it hits support or resistance. If it is strong enough to penetrate that zone, it accelerates, and your tight stop is not touched. If a trend bounces away from support or resistance, it reveals its weakness. In that case, your tight stop salvages a good chunk of profits. 2. Support and resistance are more important on long-term charts than on short-term charts. Weekly charts are more important than dailies. A good trader keeps an eye on several time frames and defers to the longer one. If the weekly trend is sailing through a clear zone, the fact that the daily trend is hitting resistance is less important. When a weekly trend approaches support or resistance, you should be more inclined to act. 3. Support and resistance levels are useful for placing stop-loss and protect-profit orders. The bottom of a congestion area is the bottom line of support. If you buy and place your stop below that level, you give the uptrend plenty of room. More cautious traders buy after an upside breakout and place a stop in the middle of a congestion area. A true upside breakout should not be followed by a pullback into the range, just as a rocket is not supposed to sink back to its launching pad. Reverse this procedure in downtrends. Many traders avoid placing stops at round numbers. This superstition began with the off-the-cuff advice by Edwards and McGee to avoid placing stops at round numbers because everybody was placing them there. Now, if traders buy copper at 92, they place a stop at 89.75 rather than 90. When they sell a stock short at 76, they place a protective stop at 80.25 rather than 80. These days, there are fewer stops at round numbers than at fractional numbers. It is better to place your stops at logical levels, round or not. Markets spend more time in trading ranges than they do in trends. Most breakouts from trading ranges are false breakouts. They suck in trend followers just before prices return into the trading range. A false breakout is the bane of amateurs, but professional traders love them. Professionals expect prices to fluctuate without going very far most of the time. They wait until an upside breakout stops reaching new highs or a downside breakout stops making new lows. Then they pounce. They fade the breakout, trade against it, and place a protective stop at the latest extreme point. It is a very tight stop, and their risk is low, while there is a big profit potential from a pullback into the congestion zone. The risk-reward ratio is so good that professionals can afford to be wrong half the time and still come out ahead of the game. The best time to buy an upside breakout on a daily chart is when your analysis of the weekly chart suggests that a new uptrend is developing. True breakouts are confirmed by heavy volume, while false breakouts tend to have light volume. True breakouts are confirmed when technical indicators reach new extreme highs or lows in the direction of the trend, while false breakouts are often marked by divergences between prices and indicators. Traders try to profit from changes in prices. Buy low and sell high, or sell short high and cover low. Even a quick look at a chart reveals that markets spend most of their time in trading ranges. They spend less time in trends. A trend exists when prices keep rising or falling over time. In an uptrend, each rally reaches a higher high than the preceding rally, and each decline stops at a higher level than the preceding decline. In a downtrend, each decline falls to a lower low than the preceding decline, and each rally stops at a lower level than the preceding rally. In a trading range, most rallies stop at about the same high, and declines peter out at about the same low. A trader needs to identify trends and trading ranges. It is easier to trade during trends. It is harder to make money when prices are flat unless you write options, which requires a special skill. Trading in trends and in trading ranges calls for different tactics. When you go long in an uptrend or sell short in a downtrend, you have to give that trend the benefit of the doubt and not be shaken out easily. It pays to buckle your seatbelt and hang on for as long as the trend continues. When you trade in a trading range, you have to be nimble and close out your position at the slightest sign of a reversal. Another difference in trading tactics between trends and trading ranges is the handling of strength and weakness. You have to follow strength during trends, buy in uptrends, and sell short in downtrends. When prices are in a trading range, you have to do the opposite, buy weakness and sell strength. An uptrend emerges when bulls are stronger than bears, and their buying forces prices up. If bears manage to push prices down, bulls return in force, break the decline, and force prices to a new high. Downtrends occur when bears are stronger and their selling pushes markets down. When a flurry of buying lifts prices, bears sell short into that rally, stop it, and send prices to new lows. When bulls and bears are equally strong or weak, prices stay in a trading range. When bulls manage to push prices up, bears sell short into that rally and prices fall. Bargain hunters step in and break the decline. Bears cover shorts, their buying fuels a minor rally, and the cycle repeats. A trading range is like a fight between two equally strong gangs. They push one another back and forth on a street corner, but neither can control the turf. A trend is like a fight where a stronger gang chases the weaker gang down the street. Every once in a while, the weaker gang stops and puts up a fight, but then is forced to turn and run again. Prices in trading ranges go nowhere, just as crowds spend most of their time in aimless milling. Markets spend more time in trading ranges than in trends because aimlessness is more common among people than purposeful action. When a crowd becomes agitated, it surges and creates a trend. Crowds do not stay excited for long. They go back to meandering. Professionals tend to give the benefit of the doubt to trading ranges. Identifying trends and trading ranges is one of the hardest tasks in technical analysis. It is easy to find them in the middle of a chart, but the closer you get to the right edge, the harder it gets. Trends and trading ranges clearly stand out on old charts. Experts show those charts at seminars and make it seem easy to catch trends. Trouble is, your broker does not allow you to trade in the middle of the chart. He says you must make your trading decisions at the hard right edge of the chart. The past is fixed and easy to analyze. The future is fluid and uncertain. By the time you identify a trend, a good chunk of it is gone. Nobody rings a bell when a trend dissolves into a trading range. By the time you recognize that change, you will lose some money trying to trade as if the market was still trending. Many chart patterns and indicator signals contradict one another at the right edge of the chart. You have to base your decisions on probabilities in an atmosphere of uncertainty. Most people cannot accept uncertainty. They have a strong emotional need to be right. They hang on to losing positions, waiting for the market to turn and make them whole. Trying to be right in the market is very expensive. Professional traders get out of losing trades fast. When the market deviates from your analysis, you have to cut losses without fuss or emotions. When you identify an uptrend and decide to buy, you have to decide whether to buy immediately or wait for a dip. If you buy fast, you get in gear with the trend, but your stops are likely to be farther away and you risk more. If you wait for a dip, you will risk less, but will have 4 groups of competitors. Longs who want to add to their positions, shorts who want to get out even, traders who never bought, and traders who sold too early but are eager to buy. The waiting area for a pullback is very crowded. Markets are not known for their charity, and a deep pullback may well signal the beginning of a reversal. This reasoning also applies to downtrends. Waiting for pullbacks while a trend is gathering steam is an amateur's game. If the market is in a trading range and you are waiting for a breakout, you have to decide whether to buy in anticipation of a breakout, during a breakout, or on a pullback after a valid breakout. If you trade multiple positions, you can buy a third in anticipation, a third on a breakout, and a third on a pullback. Whatever method you use, there is one money management rule that will keep you out of the riskiest trades. The distance from the entry point to the level of a protective stop should never be more than 2% of your account equity. No matter how attractive a trade is, pass it up if it requires a wider stop. Money management tactics are different in trends and trading ranges. It pays to put on a smaller position in a trend, but use a wider stop. Then you will be less likely to get shaken out by reactions while you keep risk under control. You may put on a bigger position in a trading range, but use a tighter stop. Finding good entry points is extremely important in trading ranges. You have to be very precise because the profit potential is so limited. A trend is more forgiving of a sloppy entry as long as you trade in the direction of the trend. Old traders chuckle. Do not confuse brains with a bull market. When you cannot tell whether the market is in a trend or in a trading range, remember that professionals give the benefit of the doubt to trading ranges. If you are not sure, stand aside. Professionals love trading ranges because they can slide in and out of positions with little risk of being impaled on a trend. Since they pay low or no commissions and suffer little slippage, it is profitable for them to trade in gently fluctuating markets. Those of us who trade away from the floor are better off trying to catch trends. You can trade less frequently during trends, and your account suffers less from commissions and slippage. Most traders ignore the fact that markets usually are both in a trend and in a trading range at the same time. They pick one time frame, such as daily or hourly, and look for trades on daily charts. With their attention fixed on daily or hourly charts, Trends from other time frames, such as weekly or 10-minute trends, keep sneaking up on them and wreaking havoc with their plans. Markets exist in several time frames simultaneously. They exist on a 10-minute chart, an hourly chart, a daily chart, a weekly chart, and any other chart. The market may look like a buy on a daily chart, but a sell on a weekly chart, and vice versa. The signals in different time frames of the same market often contradict one another. Which of them will you follow? When you are in doubt about a trend, step back and examine the charts at a time frame that is larger than the one you are trying to trade. This search for a greater perspective is one of the key principles of the triple screen trading system. A losing trader often thinks he would be better off if he had a real-time quote machine on his desk. One of the universal fantasies of losers is that they would be winners if they could get their data faster and focused on a shorter time frame. But they lose money even faster with a quote system. When that happens, some losers say they would be better off trading right on the exchange floor without any delay for data transmission. But more than half of floor traders wash out in their first year. Being in the middle of the action does not do losers any good. The conflicting signals in different time frames of the same market are one of the great puzzles in market analysis. What looks like a trend on a daily chart may show up as a blip on a flat weekly chart. What looks like a flat trading range on a daily chart shows rich uptrends and downtrends on an hourly chart, and so on. When professionals are in doubt, they look at the big picture, but amateurs focus on the short-term charts. Trend lines. Charts reveal the actions of bulls and bears. Bottoms of declines show where bears stopped and bulls regained control of the market. Peaks of rallies show where bulls ran out of steam and bears gained control. A line connecting two nearby bottoms shows the lowest common denominator of bullish power. A line that connects two nearby tops shows the lowest common denominator of the power of bears. Those lines are called trend lines. Traders use them to identify trends. When prices rally, draw an uptrend line across the bottoms. When prices decline, draw a downtrend line across the tops. Projecting those lines into the future helps anticipate buying and selling points. The most important feature of a trend line is its angle. It identifies the dominant market force. When a trend line points up, it shows that bulls are in control. Then it pays to buy with a protective stop below the trend line. When a trend line points down, it shows that bears are in control. Then it pays to sell short and protect your position with a stop above the trend line. Most chartists draw a trend line through extreme high and low points, but it is better to draw it through the edges of congestion areas. Those edges show where the majority of traders have reversed direction. Technical analysis is poll-taking, and poll-takers want to track opinions of masses, not of a few extremists. Drawing trend lines through the edges of congestion areas is somewhat subjective. You have to watch out for the temptation to slant your ruler. Panic dumping by bulls at the bottoms and panic covering by bears at the tops create extremes, which appear as long tails on the charts. You want to base your trend lines on the edges of congestion areas and not on tails, because tails show little about the crowd other than its tendency to panic. The extreme points are very important, but not for drawing trend lines. Markets usually recoil from those tails, offering opportunities to short-term traders. A bar that looks like a finger sticking out of a tight chart pattern provides a valuable reference point for short-term traders. Markets constantly fluctuate, seeking an area that generates the highest volume of trading. A tail shows that a certain price has been rejected by the market. It usually leads to a swing in the opposite direction. As soon as you recognize a tail, trade against it. Place your protective stop halfway through the tail. If the market starts chewing its tail. It is time to get out. The single most important feature of a trend line is its slope. When a trend line slants up, bulls are in control, and it pays to look for buying opportunities. When a trend line slants down, bears are in control, and it pays to look for shorting opportunities. You can rate the importance of any trend line by examining 5 factors: the time frame of the trend line, its length, the number of times prices touch it, its angle, and volume. The longer the time frame, the more important the trend line. A trend line on a weekly chart identifies a more important trend than a daily trend line. A trend line on a daily chart identifies a more important trend than an hourly trend line, and so on. The longer the trend line, the more valid it is. A short trend line reflects mass behavior over a short period. A longer trend line reflects mass behavior over a longer time. The longer a trend continues, the greater its inertia. A major bull market may follow its trend line for several years. The more contacts between prices and trend line, the more valid that line. When the trend is up, a return to the trend line shows a rebellion among bears. When the trend is down, a rally to the trend line shows a rebellion by the bulls. When prices pull back to a trend line and then bounce away from it, you know that the dominant market group has beaten the rebels. A preliminary trend line is drawn across only 2 points. 3 points of contact make that line more valid. 4 or 5 points of contact show that the dominant market crowd is firmly in control. The angle between a trend line and the horizontal axis reflects the emotional intensity of the dominant market crowd. A steep trend line shows that the dominant crowd is moving rapidly. A relatively flat trend line shows that the dominant crowd is moving slowly. A shallow trend line is likely to last longer, like a turtle racing against a hare. It pays to measure the angle of every trend line and write it down on your chart. This can be done using a computer, a protractor, or a Chinese charting tool. Comparing angles of trend lines shows whether the dominant market crowd is becoming more bullish or bearish. It is uncanny how often trend lines trace the same angle time and again in a given market. It may be because the key players seldom change. Sometimes prices accelerate away from their trend line. Then you can draw a new, steeper trend line. It shows that a trend is speeding up, becoming unsustainable. When you draw a new, steeper trend line, tighten your stop, place it immediately below the latest trend line, and adjust that stop at every new bar. The breaking of a steep trend line is usually followed by a sharp reversal. When the trend is up, volume normally expands when prices rally and shrinks when they decline. This shows that rallies attract traders while declines leave them cold. The opposite occurs in downtrends. Volume expands on declines and shrinks on rallies. A pullback on heavy volume threatens a trend line because it shows that the rebellious crowd is growing. If volume expands when prices move in the direction of a trend line, it confirms that trend line. If volume shrinks when prices pull back to a trend line, it also confirms the trend line. If volume expands when prices return to a trend line, it warns of a potential break. If volume shrinks when prices pull away from a trend line, it warns that the trend line is in danger. The breaking of a well-established trend line shows that the dominant market crowd has lost its power. You have to be careful not to anticipate trading signals. Most traders lose money when they jump the gun. A trend line is not a glass floor under the market. One crack and it is gone. It is more like a fence that bulls or bears can lean on. They can even violate it a bit without toppling it, the way animals shake a fence. A trend line break is valid only if prices close on the other side of a trend line. Some traders insist that a trend line has to be penetrated by 2 or 3 percentage points of price. After a very steep uptrend is broken, prices often rally again, retest their old high, and touch their old uptrend line from below. When that happens, you have a near-perfect shorting opportunity. A combination of a double top, a pullback to an old trend line, and perhaps a bearish divergence from technical indicators. The reverse also applies to downtrends. The neglected essentials. Volume. Volume represents the activity of traders and investors. Each unit of volume in the market reflects the action of two persons. One trader sells a share and another buys a share, or one buys a contract and another sells a contract. Daily volume is the number of contracts or shares traded in one day. Traders usually plot volume as a histogram, vertical bars whose height reflects each day's volume. They usually draw it underneath prices. Changes in volume show how bulls and bears react to price swings. Changes in volume provide clues as to whether trends are likely to continue or to reverse. Some traders ignore volume. They think that prices already reflect all information known to the market. They say, "You get paid on price and not on volume." Professionals, on the other hand, know that analyzing volume can help them understand markets deeper and trade better. There are 3 ways to measure volume. 1. The actual number of shares or contracts traded. For example, the New York Stock Exchange reports volume this way. This is the most objective way of measuring volume. 2. The number of trades that took place. For example, the London Stock Exchange reports volume this way. This method is less objective because it does not distinguish between a 100-share trade and a 5,000-share trade. 3. Tick volume is the number of price changes during a selected time, such as 10 minutes or an hour. It is called tick volume because most changes equal 1 tick. Most futures exchanges in the United States do not report intraday volume, and day traders use tick volume as its proxy. Volume reflects the degree of financial and emotional involvement, as well as pain, of market participants. A trade begins with a financial commitment by 2 persons. The decision to buy or sell may be rational, but the act of buying or selling creates an emotional commitment in most people. Buyers and sellers crave to be right. They scream at the market, pray, or use lucky talismans. Volume reflects the degree of emotional involvement among traders. Each tick takes money away from losers and gives it to winners. When prices rise, longs make money and shorts lose. When prices fall, shorts gain and longs lose. Winners feel happy and elated, while losers feel depressed and angry. Whenever prices move, about half the traders are hurting. When prices rise, bears are in pain, and when prices fall, bulls suffer. The greater the increase in volume, the more pain in the market. You can lose a great deal of money in a sleepy market, such as corn, where a 1-cent move costs only $50. If corn goes against you just a few cents a day, the pain is easy to tolerate. If you hang on, those pennies can add up to thousands of dollars in losses. Sharp moves, on the other hand, make losers cut their losses in a panic. Once weak hands get shaken out, the market is ready to reverse. Trends can last for a long time on moderate volume, but can expire after a burst of volume. Who buys from a trader who sells his losing long position? It may be a short seller taking profits and covering shorts. It may be a bargain hunter who steps in because prices are too low. That bottom picker assumes the position of a loser who washed out, and he either catches the bottom or becomes the new loser. Who sells to a trader who buys to cover his losing short position? It may be a savvy investor who takes profits on his long position. It also may be a top picker who sells short because he thinks that prices are too high. He assumes the position of a loser who covered his shorts, and only the future will tell whether he is right or wrong. When shorts give up during a rally, they buy to cover and push the market higher. Prices rise, flush out even more shorts, and the rally feeds on itself. When longs give up during a decline, they sell and push the market lower. Falling prices flush out even more longs, and the decline feeds on itself. Losers who give up propel trends. A trend that moves on steady volume is likely to continue. Steady volume shows that new losers replace those who wash out. Trends need a fresh supply of losers, the way builders of the ancient pyramids needed a fresh supply of slaves. Falling volume shows that the supply of losers is running low, and a trend is ready to reverse. It happens after enough losers catch on to how wrong they are. Old losers keep bailing out, but fewer new losers come in. Falling volume gives a sign that the trend is about to reverse. A burst of extremely high volume also gives a signal that a trend is nearing its end. It shows that masses of losers are bailing out. You can probably recall holding a losing trade longer than you should have. Once the pain becomes intolerable and you get out, the trend reverses and the market goes the way you expected, but without you. This happens time and again because most amateurs react to stress similarly and bail out at about the same time. Professionals do not hang in while the market beats them up. They close out losing trades fast and reverse or wait on the sidelines, ready to re-enter. Volume usually stays low in trading ranges because there is relatively little pain. People feel comfortable with small price changes, and trendless markets seem to drag on forever. A breakout is often marked by a dramatic increase in volume because losers run for the exits. A breakout on low volume shows little emotional commitment to a new trend. It indicates that prices are likely to return into their trading range. Rising volume during a rally shows that more buyers and short sellers are pouring in. Buyers are eager to buy even if they have to pay up, and shorts are eager to sell to them. Rising volume shows that losers who leave are being replaced by a new crop of losers. When volume shrinks during a rally, it shows that bulls are becoming less eager while bears are no longer running for cover. The intelligent bears have left long ago, followed by weak bears who could not take the pain. Falling volume shows that fuel is being removed from the uptrend and it is ready to reverse. When volume dries up during a decline, it shows that bears are less eager to sell short, while bulls are no longer running for the exits. The intelligent bulls have sold long ago, and the weak bulls have been shaken out. Falling volume shows that the remaining bulls have a higher level of pain tolerance. Perhaps they have deeper pockets, or bought later in the decline, or both. Falling volume identifies an area in which a downtrend is likely to reverse. This reasoning applies to long and short time frames. As a rule of thumb, if today's volume is higher than yesterday's volume, then today's trend is likely to continue. The terms high volume and low volume are relative. What is low for IBM is high for Apple Computer, while what is low for gold is high for platinum, and so on. As a rule of thumb, high volume for any given market is at least 25% above average for the past 2 weeks, and low volume is at least 25% below average. 1. High volume confirms trends. If prices rise to a new peak and volume reaches a new high, then prices are likely to retest or exceed that peak. 2. If the market falls to a new low and the volume reaches a new high, that bottom is likely to be retested or exceeded. A climax bottom is almost always retested on low volume, offering an excellent buying opportunity. 3. If volume shrinks while a trend continues, that trend is ripe for a reversal. When a market rises to a new peak on lower volume than its previous peak, look for a shorting opportunity. This technique does not work as well at market bottoms because a decline can persist on low volume. There is a saying on Wall Street, it takes buying to put stocks up, but they can fall of their own weight. 4. Watch volume during reactions against the trend. When an uptrend is punctuated by a decline, volume often picks up in a flurry of profit-taking. When the dip continues but volume shrinks, it shows that bulls are no longer running or that selling pressure is spent. When volume dries up, it shows that the reaction is nearing an end and the uptrend is ready to resume. This identifies a good buying opportunity. Major downtrends are often punctuated by rallies which begin on heavy volume. Once weak bears have been flushed out, volume shrinks and gives a signal to sell short. Open interest. Open interest is the number of contracts held by buyers or owed by short sellers in a given market on a given day. It shows the number of existing contracts. Open interest equals either a total long or a total short position. Stock market shares are traded for as long as a company stays in business as a separate unit. Futures and options traders, on the other hand, deal in contracts for a future delivery that expire at a set time. A futures or options buyer who wants to accept delivery and a seller who wants to deliver have to wait until the first notice day. This waiting period ensures that the numbers of contracts that are long and short are always equal. In any case, very few futures and options traders plan to deliver or to accept delivery. Most traders close out their positions before the first notice day. Open interest rises or falls depending on whether new traders enter the market or old traders exit it. Open interest rises only when a new buyer and a new seller enter the market. Their trade creates a new contract. Open interest falls when a trader who is long trades with someone who is short. When both of them close out their positions, open interest falls by one contract because one contract disappears. If a new bull buys from an old bull who is getting out of his long position, open interest remains unchanged. Open interest also does not change when a new bear sells to an old bear who needs to buy because he is closing out his short position. It takes one bull and one bear to create a futures or options contract. A bull buys a contract if he is convinced that prices are going higher. A bear sells short a contract if he is convinced that prices are going lower. When the two trade, open interest rises by one contract. A single trade between one bull and one bear is unlikely to move the markets, but when thousands of traders make their trades, they propel or reverse market trends. Open interest reflects the intensity of conflict between bulls and bears. It reflects the willingness of longs to maintain long positions and the willingness of shorts to maintain short positions. When bulls and bears do not expect the market to move in their favor, they close out their positions and open interest shrinks. There are two people on opposite sides of every trade. One of them gets hurt when prices change. If prices rally, bears get hurt. If prices fall, bulls get hurt. As long as the losers hope, they hang on and open interest does not change. A rise in open interest shows that a crowd of confident bulls is facing down a crowd of equally confident bears. It points to a growing disagreement between the two camps. One group is sure to lose, but as long as potential losers keep pouring in, the trend will continue. These ideas have been clearly put forth in L.D. Belleville's classic book, Charting Commodity Market Price Behavior. Bulls and bears keep adding to their positions as long as they strongly disagree about the future course of prices. It takes conviction and disagreement to maintain a trend. Rising open interest shows that the supply of losers is growing and the current trend is likely to persist. If open interest increases during an uptrend, it shows that longs are buying while bears are shorting because they believe that the market is too high. They are likely to run for cover when the uptrend puts a squeeze on them, and their buying will propel prices higher. If open interest rises during a downtrend, it shows that shorts are aggressively selling while bottom pickers are buying. Those bargain hunters are likely to bail out when falling prices hurt them, and their selling will push prices even lower. An increase in open interest gives a green light to the existing trend. When a bull is convinced that prices are going higher and decides to buy, but a bear is afraid to sell short, that bull can buy only from another bull who bought earlier and now wants to get out. Their trade creates no new contract, and open interest stays unchanged. When open interest stays flat during a rally, it shows that the supply of losers has stopped growing. When a bear is convinced that prices are going lower, he wants to sell short. If a bull is afraid to buy from him, that bear can only sell to another bear who shorted earlier and now wants to cover and leave. Their trade creates no new contract, and open interest does not change. When open interest stays flat during a decline, it shows that the supply of bottom pickers is not growing. Whenever open interest flattens out, it flashes a yellow light, a warning that the trend is aging and the best gains are probably behind. Falling open interest shows that losers are bailing out while winners are taking profits. When their disagreement decreases, the trend is ripe for a reversal. Open interest falls when losers abandon hope and get out of the market without being replaced by new losers. When a bull decides to get out of his long position and a bear decides to cover his short position, the two may trade with one another. When they do, a contract disappears and open interest shrinks by one contract. Falling open interest shows that winners are cashing in and losers are giving up hope. It flashes a red light. It signals the end of a trend. Time. Most people conduct their lives as if they intend to live forever, with no review of the past, no real planning for the future, and minimal learning from past mistakes. Freud showed that the unconscious mind does not have a notion of time. Our deep-seated wishes remain largely unchanged throughout life. When people join crowds, their behavior becomes even more primitive and impulsive than when they are alone. Crowds pay no attention to time even though they are affected by its passage. Individuals are ruled by the calendar and the clock, but crowds have no notion of time. Crowds act out their emotions as if they had all the time in the world. Most traders focus only on changes in prices and pay little attention to time. This is just another sign of being caught up in mass mentality. The awareness of time is a sign of civilization. A thinking person is aware of time, while someone who is acting impulsively is not. A market analyst who pays attention to time is aware of a dimension hidden from the market crowd. Long-term price cycles are a fact of economic life. For example, the U.S. stock market tends to run in 4-year cycles. They exist because the ruling party inflates the economy going into the presidential election once every 4 years. The party that wins the election deflates the economy when voters cannot take revenge at the polls. Flooding the economy with liquidity lifts the stock market, and draining liquidity pushes it down. This is why the 2 years before a presidential election tend to be bullish, and the first 12 to 18 months following an election tend to be bearish. Major cycles in agricultural commodities are due to fundamental production factors coupled with the mass psychology of producers. For example, when livestock prices rise, farmers breed more animals. When those animals reach the market, prices fall and producers cut back. When the supply is absorbed, Scarcity pushes prices up, breeders go to work again, and the bull-bear cycle repeats. This cycle is shorter in hogs than in cattle because pigs breed faster than cows. Long-term cycles can help traders identify market tides. Instead, most traders get themselves in trouble by trying to use short-term cycles for precision timing and predicting minor turning points. Price peaks and valleys on the charts often seem to follow in an orderly manner. Traders reach for a pencil and a ruler, measure distances between neighboring peaks, and project them into the future to forecast the next top. Then they measure distances between recent bottoms and extend them into the future to forecast the next low. Cycles put bread and butter on the tables of several experts who sell services forecasting highs and lows. Few of them realize that what appears like a cycle on the charts is often a figment of the imagination. If you analyze price data using a mathematically rigorous program, you will see that approximately 80% of what appears like cycles is simply market noise. A human mind needs to find order in chaos, and an illusion of order is better than no order for most people. If you look at any river from the air, it appears to have cycles, swinging right and left. Every river meanders in its valley because water flows faster in its middle than near the shores, creating turbulences that force the river to turn. Looking for market cycles with a ruler and a pencil is like searching for water with a divining rod. Profits from an occasional success are erased by many losses due to unsound methods. If you are serious about trading with cycles, you need a mathematical method for finding them. A farmer sows in spring, harvests in late summer, and uses the fall to get ready for winter. There is a time to sow and a time to reap, a time to bet on a warm trend, and a time to get ready for a cold spell. The concept of seasons can be applied to the financial markets. A trader can use a farmer's approach. He should look to buy in spring, sell in summer, go short in the fall, and cover in winter. Just as a farmer pays attention to the vagaries of weather, a trader needs to pay attention to the vagaries of the markets. An autumn on the farm can be interrupted by an Indian summer, and a market can stage a strong rally in autumn. A sudden freeze can hit the fields in spring, and the market can drop early in a bull move. A trader needs to use his judgment and apply several indicators and techniques to avoid getting whipsawed. The concept of indicator seasons focuses a trader's attention on the passage of time in the market. It helps you plan for the season ahead instead of jumping in response to other people's actions. Psychological indicators. Many private traders keep their market opinions to themselves, but financial journalists and market letter writers spew them forth like open fire hydrants. Some writers are very bright, but both groups as a whole have poor trading records. Financial journalists and letter writers overstay important trends and miss major turning points. When these groups become bullish or bearish, it pays to trade against them. The behavior of groups is more primitive than individual behavior. Consensus indicators, also known as contrary opinion indicators, are not as exact as trend-following indicators or oscillators. They simply draw your attention to the fact that a trend is ready to reverse. When you get that message, use technical indicators for more precise timing. As long as the market crowd remains in conflict, the trend can continue. When the crowd reaches a strong consensus, the trend is ready to reverse. When the crowd becomes highly bullish, it pays to get ready to sell. When the crowd becomes strongly bearish, it pays to get ready to buy. The reason for trading against the extremes in consensus is rooted in the structure of the futures markets. The number of contracts bought long and sold short is always equal. For example, if open interest in gold is 12,000 contracts, then 12,000 contracts are long and 12,000 contracts are short. While the number of long and short contracts is always equal, the number of individuals who hold them keeps changing. If the majority is bullish, then the minority, those who are short, has more contracts per person than the longs. If the majority is bearish, then the bullish minority has bigger positions per person. If bullish consensus equals 50%, then 50% of traders are long and 50% are short. An average trader who is long holds as many contracts as an average trader who is short. When bullish consensus reaches 80%, it shows that 80% of traders are long and 20% are short. Since the sizes of total long and total short positions are always equal, an average bear is short 4 times as many contracts as are held long by an average bull. This means that an average bear has 4 times more money than an average bull. The big money is on the short side of the market. When bullish consensus falls to 20%, it means that 20% of traders are long and 80% are short. Since the numbers of long and short contracts are always equal, an average bull holds 4 times more contracts than are held by an average bear. It shows that big money is on the long side of the market. Big money did not grow big by being stupid. Big traders tend to be more knowledgeable and successful than average. Otherwise, they stop being big traders. When big money gravitates to one side of the market, think of trading in that direction. To interpret bullish consensus in any market, obtain at least 12 months of historical data on consensus and note the levels at which the market has turned in the past. Update these levels once every 3 months. The next time the market consensus becomes highly bullish, look for an opportunity to sell short using technical indicators. When the consensus becomes very bearish, look for a buying opportunity. Advisory opinion sometimes begins to change a week or two in advance of major trend reversals. If bullish consensus ticks down from 78 to 76, or if it rises from 25 to 27, it shows that the savviest advisors are abandoning what looks like a winning trend. This means that the trend is ready to reverse. Several government agencies and exchanges collect data on buying and selling by several groups of investors and traders. They publish summary reports of actual trades, commitments of money as well as ego. It pays to trade with those groups that have a track record of success and bet against those with poor track records. For example, the Commodity Futures Trading Commission, CFTC, reports long and short positions of hedgers and big speculators. Hedgers, the commercial producers and consumers of commodities, are the most successful participants in the futures markets. The Securities and Exchange Commission, SEC, reports purchases and sales by corporate insiders. Officers of publicly traded companies know when to buy or sell their company shares. The New York Stock Exchange reports the number of shares bought, sold, and shorted by its members and by odd-lot traders. Members are more successful than small-time speculators. Traders must report their positions to the CFTC after they reach certain levels, called reporting levels. At the time of this writing, if you are long or short 100 contracts of corn or 300 contracts of the S&P 500 futures, the CFTC classifies you as a big speculator. Brokers send reports on positions that reach reporting levels to the CFTC. It compiles them and releases summaries once every 2 weeks. The CFTC also sets up the maximum number of contracts, called position limits, that a speculator is allowed to hold in any given market. At this time, a speculator may not be net long or short more than 2,400 contracts of corn or 500 contracts of the S&P 500 futures. These limits are set to prevent very large speculators from accumulating positions that are big enough to bully the markets. The CFTC divides all market participants into 3 groups: commercials, small speculators, and large speculators. Commercials, also known as hedgers, are firms or individuals who deal in actual commodities in the normal course of business. In theory, they trade futures to hedge business risks. For example, a bank trades interest rate futures to hedge its loan portfolio, or a food processing company trades wheat futures to offset the risks of buying grain. Hedgers post small margins and are exempt from speculative position limits. Large speculators are those traders whose positions reach reporting levels. The CFTC reports buying and selling by commercials and large speculators. To find the positions of small traders, you need to subtract the holdings of the first two groups from the open interest. The divisions between hedgers, big speculators, and small speculators are somewhat artificial. Smart small traders grow into big traders, dumb big traders become small traders, and many hedgers speculate. Some market participants play games that distort the CFTC reports. For example, an acquaintance who owns a brokerage firm sometimes registers his wealthy speculator clients as hedgers, claiming they trade stock index and bond futures to hedge their stock and bond positions. The commercials can legally speculate in the futures markets using inside information. Some of them are big enough to play futures markets against cash markets. For example, an oil firm may buy crude oil futures, divert several tankers, and hold them offshore in order to tighten supplies and push futures prices up. They can take profits on long positions, go short, and deliver several tankers at once to refiners in order to push crude futures down and cover shorts. This manipulation is illegal, and most firms hotly deny that it takes place. As a group, the commercials have the best track record in the futures markets. They have inside information and are well capitalized. It pays to follow them because they are successful in the long run. The few exceptions, such as orange juice hedgers, only confirm this rule. Big speculators used to be highly successful as a group until a decade or so ago. They used to be wealthy individuals who took careful risks with their own money. Today's big traders are commodity funds. These trend-following behemoths do poorly as a group. The masses of small traders are the proverbial wrong-way Corrigans of the markets. It is not enough to know whether a certain group is short or long. Commercials are often short futures because many of them own physical commodities. Small traders are usually long, reflecting their perennial optimism. To draw valid conclusions from the CFTC reports, you need to compare current positions to their historical norms. Trading systems. The Triple Screen Trading System. The Triple Screen Trading System was developed by this author and has been used for trading since 1985. It was first presented to the public in April 1986 in an article in Futures magazine. Triple Screen applies 3 tests or screens to every trade. Many trades that seem attractive at first are rejected by one or another screen. Those trades that pass the triple screen test have a higher degree of profitability. Triple Screen combines trend-following methods and counter-trend techniques. It analyzes all potential trades in several time frames. Triple Screen is more than a trading system, it is a method, a style of trading. Beginners often look for a magic bullet, a single indicator for making money. If they get lucky for a while, they feel as if they discovered the royal road to profits. When the magic dies, amateurs give back their profits with interest and go looking for another magic tool. The markets are too complex to be analyzed with a single indicator. Different indicators give contradictory signals in the same market. Trend-following indicators rise during uptrends and give buy signals, while oscillators become overbought and give sell signals. Trend-following indicators turn down in downtrends and give signals to sell short, but oscillators become oversold and give buy signals. Trend-following indicators are profitable when markets are moving, but lead to whipsaws in trading ranges. Oscillators are profitable in trading ranges, but give premature and dangerous signals when the markets begin to trend. Traders say, "The trend is your friend," and "let your profits run." They also say, "Buy low, sell high." But why sell if the trend is up? And how high is high? Some traders try to average out the votes of trend-following indicators and oscillators. It is easy to rig this vote. If you use more trend-following tools, the vote will go one way, and if you use more oscillators, it will go the other way. A trader can always find a group of indicators telling him what he wants to hear. The triple screen trading system combines trend-following indicators with oscillators. It is designed to filter out their disadvantages while preserving their strengths. Another major dilemma is that the trend can be up and down at the same time, depending on what chart you use. A daily chart may show an uptrend, while a weekly chart shows a downtrend, and vice versa. A trader needs to handle conflicting signals in different time frames. Charles Dow, the author of the venerable Dow theory, stated at the turn of the century that the stock market had three trends. The long-term trend lasted several years, the intermediate trend several months, and anything shorter than that was a minor trend. Robert Rhea, the great market technician of the 1930s, compared the three market trends to a tide, a wave, and a ripple. He believed that traders should trade in the direction of the market tide and take advantage of the waves, but ignore the ripples. Times have changed, and the markets have become more volatile. Traders need a more flexible definition of time frames. The triple screen trading system is based on the observation that every time frame relates to the larger and shorter ones by approximately a factor of 5. Each trader needs to decide which time frame he wants to trade. Triple screen calls that the intermediate time frame. The long-term time frame is one order of magnitude longer. The short-term time frame is one order of magnitude shorter. For example, if you want to carry a trade for several days or weeks, then your intermediate time frame will be defined by the daily charts. Weekly charts are one order of magnitude longer, and they determine the long-term time frame. Hourly charts are one order of magnitude shorter, and they determine the short-term time frame. Day traders who hold their positions for less than an hour can use the same principle. For them, a 10-minute chart may define the intermediate time frame, an hourly chart the long-term time frame, and a 2-minute chart the short-term time frame. Triple screen demands that you examine the long-term chart first. It allows you to trade only in the direction of the tide, the trend on the long-term chart. It uses the waves that go against the tide for entering positions. For example, daily declines create buying opportunities when the weekly trend is up. Daily rallies provide shorting opportunities when the weekly trend is down. First screen, market tide. Triple screen begins by analyzing the long-term chart, one order of magnitude greater than the one you plan to trade. Most traders pay attention only to the daily charts, with everybody watching the same few months of data. If you begin by analyzing weekly charts, your perspective will be 5 times greater than that of your competitors. A trader has 3 choices: buy, sell, or stand aside. The first screen of the triple screen trading system takes away one of those choices. It acts as a censor who permits you only to buy or stand aside during major uptrends. It allows you only to sell short or stand aside during major downtrends. You have to swim with the tide or stay out of the water. Second screen, market wave. The second screen identifies the wave that goes against the tide. When the weekly trend is up, daily declines point to buying opportunities. When the weekly trend is down, daily rallies point to shorting opportunities. The second screen applies oscillators to the daily charts in order to identify deviations from the weekly trend. Oscillators give buy signals when markets decline and sell signals when markets rise. The second screen of the triple screen trading system allows you to take only those daily signals that point in the direction of the weekly trend. Third screen, intraday breakout. The first screen of the triple screen trading system identifies market tide on a weekly chart. The second screen identifies a wave that goes against that tide on a daily chart. The third screen identifies the ripples in the direction of the tide. It uses intraday price action to pinpoint entry points. The third screen does not require a chart or an indicator. It is a technique for entering the market after the first and second screens gave a signal to buy or sell short. The third screen is called a trailing buy-stop technique in uptrends and a trailing sell-stop technique in downtrends. When the weekly trend is up and the daily trend is down, trailing buy-stops catch upside breakouts. When the weekly trend is down and the daily trend is up, trailing sell-stops catch downside breakouts. When the weekly trend is up and a daily oscillator declines, it activates a trailing buy-stop technique. Place a buy order one tick above the high of the previous day. If prices rally, you will be stopped in long automatically when the rally takes out the previous day's high. If prices continue to decline, your buy stop will not be touched. Lower your buy order the next day to the level one tick above the latest price bar. Keep lowering your buy stop each day until stopped in, or until the weekly indicator reverses and cancels its buy signal. When the weekly trend is down, wait for a rally in a daily oscillator to activate a trailing sell-stop technique. Place an order to sell short one tick below the latest bar's low. As soon as the market turns down, you will be stopped in on the short side. If the rally continues, keep raising your sell order daily. The aim of a trailing sell-stop technique is to catch an intraday downside breakout from a daily uptrend in the direction of a weekly downtrend. Proper money management is essential for successful trading. A disciplined trader cuts his losses short and outperforms a loser who keeps hanging on and hoping. The triple screen trading system calls for placing very tight stops. As soon as you buy, place a stop-loss order one tick below the low of the trade day or the previous day, whichever is lower. Once you sell short, place a protective stop-loss one tick above the high of the trade day or the previous day, whichever is higher. Move your stop to a break-even level as soon as the market moves in your favor. Afterwards, the rule of thumb is to move your stop to protect approximately 50% of paper profits. The reason for using such tight stops is that triple screen trades only in the direction of the tide. If a trade does not work out fast, it is a sign that something is fundamentally changing below the surface of the market. Then it is better to run fast. The first loss is the best loss. It allows you to re-examine the market from the safety of the sidelines. Conservative traders should go long or short on the first signal of the triple screen trading system and stay with that position until the major trend reverses or until stopped out. Active traders can use each new signal from the daily oscillator for pyramiding the original position. A position trader should try and stay with a trade until the weekly trend reverses. A short-term trader may take profits using signals from the second screen. For example, if a trader is long and force index becomes positive or stochastic rises to 70%, he may sell and take profits, then look for another buying opportunity. The triple screen trading system combines different time frames and several types of indicators. It uses a trend-following indicator with the long-term charts and a short-term oscillator with the intermediate charts. It uses special entry techniques for buying or selling short. It also uses tight money management rules. Channel trading systems. Prices often flow in channels, the way rivers flow in valleys. When a river touches the right edge of its valley, it turns left. When a river touches the left rim of its valley, it turns right. When prices rally, they often seem to stop at an invisible ceiling. When they fall, they often seem to hit an invisible floor. Channels help traders identify buying and selling opportunities and avoid bad trades. Channels parallel to trend lines are useful for long-term analysis, especially on the weekly charts. Channels around moving averages are useful for short-term analysis, especially on daily and intraday charts. Channels whose width depends on volatility are good for catching early stages of major new trends. Support is where buyers buy with greater intensity than sellers sell. Resistance is where sellers sell with greater intensity than buyers buy. Channels show where to expect support and resistance in the future. A channel's slope identifies a market's trend. When a channel lies flat, you may trade all swings within its walls. When a channel rises, it pays to trade only from the long side, buying at the lower wall and selling at the upper wall. When a channel declines, it pays to trade only from the short side, shorting at the upper channel wall and covering at the lower wall. When prices rise above the average consensus of value, sellers see an opportunity to take profits on long positions or go short. When they overpower the bulls, prices decline. When prices fall below the moving average, bargain hunters step in. Their buying and short covering by bears lift prices, and the cycle repeats. When prices are near their moving average, the market is fairly valued. When prices are at or below the lower channel line, the market is undervalued. When prices are at or above the upper channel line, the market is overvalued. Channels help traders find buying opportunities when the market is cheap and shorting opportunities when the market is dear. The market is like a manic depressive person. When he reaches the height of mania, he is ready to calm down, and when he reaches the bottom of his depression, his mood is ready to improve. A channel marks the limits of mass optimism and pessimism. Its upper line shows where bulls run out of steam, and its lower line shows where bears become exhausted. Every animal fights harder closer to home. The upper channel line shows where bears have their backs against the wall and fight off the bulls. The lower channel line shows where bulls have their backs against the wall and fight off the bears. When a rally fails to reach the upper channel line, it is a bearish sign. It shows that bulls are becoming weaker. If a rally shoots out of a channel and prices close above it, it shows that the uptrend is strong. The reverse rules apply in downtrends. Channels help traders who use them remain objective when others get swept up in bullish or bearish hysteria. If prices touch the upper channel line, you see that mass bullishness is being overdone, and it is time to think about selling. When everyone turns bearish, but prices touch the lower channel line, you know that it is time to think about buying instead of selling. Amateurs and market professionals handle channels differently. Amateurs bet on long shots. They tend to buy upside breakouts and sell short downside breakouts. When an amateur sees a breakout from a channel, he hopes that a major new trend is about to begin and make him rich quick. Professionals trade against deviations and for a return to normalcy. It is normal for prices to remain within channels. Most breakouts are exhaustion moves that are quickly aborted. Professionals like to fade them, trade against them. They sell short as soon as an upside breakout stalls and buy when a downside breakout stops reaching new lows. Breakouts can produce spectacular gains for amateurs when a major new trend blows out of a channel. Amateurs occasionally win, but it pays to trade with the professionals. Most breakouts are false and are followed by reversals. Risk management. Trading is so exciting that it often makes amateurs feel high. A trade for them is like a ticket to a movie or a professional ball game. Trading is a much more expensive entertainment than the cinema. Nobody can get high and make money at the same time. Emotional trading is the enemy of success. Greed and fear are bound to destroy a trader. You need to use your intellect instead of trading on gut feeling. A trader who gets giddy from profits is like a lawyer who starts counting cash in the middle of a trial. A trader who gets upset at losses is like a surgeon who faints at the sight of blood. A real professional does not get too excited about wins or losses. The goal of a successful professional in any field is to reach his personal best, to become the best doctor, the best lawyer, or the best trader. Money flows to them almost as an afterthought. You need to concentrate on trading right and not on the money. Each trade has to be handled like a surgical procedure, seriously, soberly, without sloppiness or shortcuts. Emotional traders want certain gains and turn down profitable wagers that involve uncertainty. They go into risky gambles to avoid taking certain losses. It is human nature to take profits quickly and postpone taking losses. Irrational behavior increases when people feel under pressure. Emotional trading destroys losers. If you review your trading records, you will see that the real damage to your account was done by a few large losses, or by long strings of losses while trying to trade your way out of a hole. Good money management would have kept you out of the hole in the first place. You can win only if you trade with a positive mathematical expectation, a sensible trading system. Trading on hunches leads to disasters. Many traders act like drunks wandering through a casino, going from game to game. Slippage and commissions destroy those who overtrade. The best trading systems are crude and robust. They are made of a few elements. The more complex the systems, the more elements that can break. Traders love to optimize their systems using past data. The trouble is, your broker won't let you trade the past. Markets change, and the ideal parameters from the past may be no good today. Try to de-optimize your system instead. Check how it would have performed under bad conditions. A robust system holds up well when markets change. It is likely to beat a heavily optimized system in real-world trading. Finally, when you develop a good system, don't mess with it. Design another one if you like to tinker. As Robert Prechter put it, most traders take a good system and destroy it by trying to make it into a perfect system. Once you have your trading system, it is time to set the rules for money management. Suppose you and I bet a penny on a coin flip. Tails you win, heads you lose. Suppose you have $10 of risk capital and I have $1. Even though I have less money, I have little to fear. It would take a string of 100 losses to wipe me out. We can play for a long time, unless two brokers get between us and drain our capital by commissions and slippage. The odds will dramatically change if you and I raise our bet to a quarter. If I have only $1, then a string of only 4 losses will destroy me. If you have $10, you can afford to lose a quarter 40 times in a row. A series of 4 losses is likely to come much sooner than 40. All other factors being equal, the poorer of 2 traders is the first to go broke. Most amateurs think that other factors are far from equal. They consider themselves brighter than the rest of us. The trading industry works hard to reinforce that delusion, telling traders that winners get the money lost by losers. They try to hide the fact that trading is a minus-sum game. Cocky amateurs take wild risks, producing commissions for brokers and profits for floor traders. When they blow themselves out of the market, new suckers come in because hope springs eternal. Institutional traders as a group tend to be more successful than private traders. They owe it to their bosses, who enforce discipline. If a trader loses more than his limit on a single trade, he is fired for insubordination. If he loses his monthly limit, his trading privileges are suspended for the rest of the month and he becomes a gopher, fetching other traders coffee. If he loses his monthly limit several times in a row, the company either fires or transfers him. This system makes institutional traders avoid losses. Private traders have to be their own enforcers. An amateur who opens a $20,000 trading account and expects to run it into $1 million in 2 years is like a teenager who runs away to Hollywood to become a pop singer. He may succeed, but the exceptions only confirm the rule. Amateurs like to get rich quick, but destroy themselves by taking wild risks. They may succeed for a while, but hang themselves, given enough rope. Amateurs often ask me what percentage profit they can make annually from trading. The answer depends on their skills or lack of such and market conditions. Amateurs never ask a more important question. How much will I lose before I stop trading and reevaluate myself, my system, and the markets? If you focus on handling losses, profits will take care of themselves. A person who makes 25% profit annually is a king of Wall Street. Many top-flight money managers would give away their firstborn child to be able to top this. A trader who can double his money in a year is a star, as rare as a pop musician or a top athlete. If you set modest goals for yourself and achieve them, you can go very far. If you can make 30% annually, people will beg you to manage their money. If you manage $10 million, not an outlandish amount in today's markets, your management fee alone can run 6% of that, or $600,000 a year. If you make a 30% profit, you will keep 15% of it as an incentive fee, another $450,000. You will earn over $1 million a year trading without taking big risks. Keep these numbers in mind when you plan your next trade. Trade to establish the best track record with steady gains and small drawdowns. Most traders get killed by one of 2 bullets: ignorance or emotion. Amateurs act on hunches and stumble into trades that they should never take due to negative mathematical expectations. Those who survive the stage of virginal ignorance go on to design better systems. When they become more confident, they lift their heads out of the foxholes, and the second bullet hits them. Confidence makes them greedy, they risk too much money on a trade, and a short string of losses blows them out of the market. If you bet a quarter of your account on each trade, your ruin is guaranteed. You will be wiped out by a very short losing streak, which happens even with excellent trading systems. Even if you bet a tenth of your account on a trade, you will not survive much longer. A professional cannot afford to lose more than a tiny percentage of his equity on a single trade. An amateur has the same attitude toward trading as an alcoholic has toward drinking. He sets out to have a good time, but winds up destroying himself. Extensive testing has shown that the maximum amount a trader may lose on a single trade without damaging his long-term prospects is 2% of his equity. This limit includes slippage and commissions. If you have a $20,000 account, you may not risk more than $400 on any trade. If you have a $100,000 account, you may not risk more than $2,000 on a trade. But if you have only $10,000 in your account, then you can risk no more than $200 on a trade. Most amateurs shake their heads when they hear this. Many have small accounts, and the 2% rule throws a monkey wrench into the dreams of quick profits. Most successful professionals, on the other hand, consider the 2% limit too high. They do not allow themselves to risk more than 1% or 1.5% of their equity on any single trade. The 2% rule puts a solid floor under the amount of damage the market can do to your account. Even a string of 5 or 6 losing trades will not cripple your prospects. In any case, if you are trading to create the best track record, you will not want to show more than a 6% or 8% monthly loss. When you hit that limit, stop trading for the rest of the month. Use this cooling off period to re-examine yourself, your methods, and the markets. The 2% rule keeps you out of riskier trades. When your system gives an entry signal, check to see where to place a logical stop. If that would expose more than 2% of your account equity, pass up that trade. It pays to wait for trades that allow very close stops. Waiting for them reduces the excitement of trading, but enhances profit potential. You choose which of the two you really want. The 2% rule helps you decide how many contracts to trade. For example, if you have $20,000 in your account, you may risk up to $400 per trade. If your system flags an attractive trade with a $275 risk, then you may trade only one contract. If the risk is only $175, then you can afford to trade 2 contracts. What about pyramiding? Increasing the size of your trading positions as a trade moves in your favor. The 2% rule helps here too. If you show profit on a trend-following position, you may add to it, as long as your existing position is at a break-even level or better, and the risk on the additional position does not exceed 2% of your equity. The goal of a successful trader is to make the best trades. Money is secondary. If this surprises you, think how good professionals in any field operate. Good teachers, doctors, lawyers, farmers, and others make money, but they do not count it while they work. If they do, the quality of their work suffers. If you ask your doctor how much money he earned today, he won't be able to answer, and if he can, you do not want him for a doctor. Ask your lawyer how much money he made today. He may have a general idea that he put in some billable hours, but not exactly how many dollars he made. If he counts money while he works, you do not want him for a lawyer. A real pro devotes all his energy to practicing his craft the best he can, not to counting money. Counting money in a trade flashes a red light, a warning that you are about to lose because your emotions are kicking in and they will override your intellect. That is why it is a good idea to get out of a trade if you cannot get money off your mind. Concentrate on quality, on finding trades that make sense, and having a money management plan that puts you in control. Focus on finding good entry points and avoid gambles. Then the money will follow almost as an afterthought. You may count it later, well after a trade is over. A good trader must focus on finding and completing good trades. A professional always studies the markets, looks for opportunities, hones his money management skills, and so on. If you ask him how much money he made on the current trade, he will have only a general idea of being a little or a lot ahead of the game, or a little behind. He can never be a lot behind because of tight stops. Like other professionals, he focuses on practicing his craft and polishing his skills. He does not count money in a trade. He knows that he will make money as long as he does what is right in the markets. If you use indicators for finding trades, use them also to get you out of trades. If your indicators are in gear with the market when it is time to buy or go short, use them to decide when it is time to sell or to cover. A trader often becomes emotionally attached to a trade. Profits give people a high, but even a loss can tingle the nerves, like a scary but exciting ride on a roller coaster. When those indicator signals that flagged a trade disappear, get out of the market fast, regardless of your feelings. Some traders try to establish profit targets. They want to sell strength when prices hit resistance or buy weakness when prices reach support. Elliott wave theory is the main method for trying to forecast reversal points. R.N. Elliott wrote several articles about the stock market and a book, Nature's Law. He believed that every movement in the stock market could be broken into waves, smaller waves, and subwaves. Those waves explained every turning point and occasionally allowed him to make correct predictions. Those analysts who sell advisory services based on Elliott's methods always come up with so-called alternate counts. They explain everything in hindsight, but are not reliable in dealing with the future. Fibonacci numbers and their ratios, especially 1.618, 2.618, and 4.236, express many relationships in nature. As Trudy Garland writes in her lucid book, Fascinating Fibonacci's, these numbers express the ratios between the diameters of neighboring spirals in a seashell and in a galaxy, the number of seeds in the adjacent rows of a sunflower, and so on. Elliott was the first to point out that these relationships also apply to the financial markets. Tony Plummer describes in his book, Forecasting Financial Markets, how he uses Fibonacci ratios to decide how far a breakout from a trading range is likely to carry. He measures the height of a trading range, trades in the direction of a breakout, and then looks for reversal targets by multiplying the height of the range by Fibonacci numbers. Experienced traders combine profit targets with other technical studies. They look for indicator signals at the projected turning points. If indicators diverge from a trend that is approaching a target, it reinforces the signal to get out. Trading on targets alone can be a tremendous ego boost, but the markets are too complex to be handled with a few simple numbers. Setting stops. Serious traders place stops the moment they enter a trade. As time passes, stops need to be adjusted to reduce the amount of money at risk and to protect a bigger chunk of profit. Stops should be moved only one way, in the direction of the trade. We all like to hope that a trade will succeed, and a stop is a piece of reality that prevents traders from hanging on to empty hope. When you are long, you may keep your stops in place or raise them, but never lower them. When you are short, you may keep your stops in place or lower them, but never raise them. Cutting extra slack to a losing trade is a loser's game. If a trade is not working out, it shows that your analysis was flawed or the market has changed. Then it is time to run fast. Serious traders use stops the way sailors use ratchets, to take out the slack in their sails. Losers who move stops away from the market vote in favor of fantasy and against reality. Learning to place stops is like learning to drive defensively. Most of us learn the same techniques and we adjust them to fit our personal styles. The following are the basic rules for placing stops. 1. Stop-loss order. Place your stop the moment you enter a trade. Trading without a stop is like walking down Fifth. It can be done. I have seen people do it, but it is not worth the trouble. A stop will not protect you from a bad trading system. The best it can do is slow down the damage. A stop-loss order limits your risk, even though it does not always work. Sometimes prices gap through a stop. A stop is not a perfect tool, but it is the best defensive tool we have. When you go long, place your stop below the latest minor support level. When you go short, place a stop above the latest minor resistance. The parabolic system trade depending on the passage of time and changes in prices. If you use the triple screen trading system, place your stop after entering a trade at the extreme of the past 2 days' range. Avoid all trades where a logical stop would expose more. This limit includes slippage. 2. Break-even order. Hardest. You have done your homework, found a trade, and placed an order. It has been filled, and you placed a stop-loss order. There is not much else you can do. You are like a pilot strapped into his seat for takeoff. The engines are blasting at full power, but the speed is low, and there is no room to maneuver. Just sit back and trust your system. As soon as prices start to move in your favor, break-even level. When the takeoff is completed, your flight is at a safer stage. Now you get to choose between keeping your money or gaining more, instead of choosing between a loss and a gain. As a rule, prices have to move away from your entry point by more than the average daily range before you move your stop to a break-even level. It takes judgment and experience to know when to do it. When you move a stop to a break-even level, you increase the risk of a whipsaw. Amateurs often kick themselves for leaving money on the table. Many amateurs allow themselves only one entry into a trade. There's nothing wrong with re-entering a trade after getting stopped out. Professionals keep trying to get in until they get a good entry using tight money management. 3. Protect. Profit order. As prices continue to move in your favor, you have to protect your paper profits. Paper profit is real money. Treat it with the same respect as money in your wallet. Risk only a portion of it as the price of staying in the trade. If you are a conservative trader, apply the 2% rule to your paper profits. This protect profit order is a money stop, protecting your equity. Keep moving it in the direction of the trade so that no more than 2% of your growing equity is ever exposed. More aggressive traders use the 50% rule. If you follow it, half the paper profit is yours and half belongs to the market. You can mark the highest high reached in a long trade or the lowest low reached in a short trade and place your stop halfway between that point and your entry point. For example, if prices move 10 points in your favor, place a stop to protect 5 points of profit. If in doubt, use the parabolic system to help you adjust your stops. When you are not sure whether to stay in a trade or not, take profits and reevaluate the situation from the sidelines. There is nothing wrong with exiting and re-entering a trade. People think much more clearly when they have no money at risk. A trade does not end when you close out your position. You must analyze it and learn from it. Many traders throw their confirmation slips into a folder and go looking for the next trade. They miss an essential part of growing to become a professional trader: review and self-analysis. Have you identified a good trade? Which indicators were useful and which did not work? How good was your entry? Was the initial stop too far or too close? Why and by how much? Did you move late or too late? Were your protect profit stops too loose or too tight? Did you recognize the signals to exit a trade? What should you have done differently? What did you feel at the various stages of the trade? This analysis is an antidote against emotional trading. Ask yourself these and other questions and learn from your experiences. A cool, intelligent analysis does you more good than gloating about profits or wallowing in regrets. Start keeping a before and after notebook. Whenever you enter a position, print out the current charts. Paste them on the left page of your notebook and jot down your main reasons for buying or shorting. Write down your plan for managing the trade. when you exit, print the charts again and paste them on the right page of your notebook. Write down your reasons for exiting and list what you did right or wrong. You will have a pictorial record of your trades and thoughts. This notebook will help you learn from the past and discover blind spots in your thinking. Learn from history and profit from your experiences. This is Richard Davidson for Wiley Audio. Thank you for listening. This audiobook is a co-production of Penton Overseas and Audio Scholar, and is based upon the book entitled Trading for a Living by Dr.
Greetings, traders. It is I, Abdul Shabazz, and this is some real change stock options trading journey. Let's go. On this fantastic, fabulous, terrific, wonderful Wednesday afternoon, the last Wednesday of the month, the last day of the month of July in the year of 2024. Lot going on today. I did not trade at all this morning, was able to handle some well-needed business. Grateful for the opportunity to do that. But as I look in the chat, I see what the team was talking about. Let's run it down real quick. Great audio book. What was that book? Very eye-opening. Okay. That book was Alexander L. was the author of that. Trading for a Living is the name of that book. Aaron wanted to know the same thing. Great book, great author. Even came out with a revised version called The New Trading for a Living. Has been updated and it even comes with a workbook. Matthew said, oh, didn't see the blip about the audio book. Had this thing muted. He took a call at the 10-10 candle, sold at the top of the 10-15 candle. Nice win, safe win. Never traded in the red. More money. Wanted to know the same thing. The name of the audio book by Alexander L. Matthew said today wasn't scary or wild, as it maybe would have appeared. I took two great trades. The call, as he mentioned above, and then the put at 10:45. And I was out at the bottom of the very next candle. Two textbook setup. Beautiful trading, Matthew. And Aaron chimed in, if I'm correct, from the ending of the book, it is The New Trading for a Living. Psychology, Discipline, Trading Tools and System, Risk Control and Risk Trade Management by Alexander L. That would be correct. And now, we're going to go ahead and take it on over and see if we can't tap into a live feed of what is going on with the Fed. Let's get ready to take it away and hand it over to the Fed.
Gained greater confidence that inflation is moving sustainably toward 2%. There's also no change in the overall assessment that economic activity has continued to expand at a solid pace. All of the adjustments are basically to adjectives. Job gains have moderated, the statement says, instead of remained strong. Unemployment has moved up, but remains low. Inflation has eased over the past year, but remains somewhat elevated. And in recent months, there has been some further progress toward the 2% inflation goal. If there is a hint about the future, it's this. Instead of saying risks to employment and inflation have moved into better balance, the statement now says the committee is attentive to the risks on both sides of its dual mandate. The decision was unanimous, and that's basically it. If there is going to be a hint about a September move, it's going to be up to Chairman Powell.
It's a two-part story, Mike McKee. This was the first part. The second part starts at about 29 minutes with that news conference and Chairman Powell. Let's get to the equity market. We stay positive on the S&P 500, up by about 1.5%. On the Nasdaq 100, up by 2.5%. In the bond market, yields look a little something like this. We're down about 2 basis points on a 10-year. The move at the front end of the curve, it's a small one, but notable, up by about 2 basis points. points on a 2-year at 438.32. I just want to get to those changes that Mike McKee identified. If you go back to the second paragraph of the June statement, the last line of that paragraph read as follows: the economic outlook is uncertain and the committee remains highly attentive to inflation risk. If you go to the second paragraph and the last line of the statement that just dropped, the economic outlook is uncertain and the committee is attentive to the risk to both sides of its dual mandate. And Lisa, this is the story of the dual mandate and the risks around it coming into balance. That looks like the way they formalized it this time around in the statement. And I just wonder how much the chairman builds on that in the news conference in 28 minutes.
I want to pick up on your point that the bond market isn't moving that much. There's only an increase of about 2 basis points on the front end, and that is why. Exactly that. They recognize the risk that the labor market is one that they have to care about. This sets up Jackson Hole for him to come out and sort of change the framework, and then for September to be that first rate cut. No one's changing that view based on this particular statement.
The balance of risks has shifted, and you start to see it appear just a little bit incrementally in the statement. The decision, rates unchanged. We're looking for a move still in September. To Lisa's point, we still have a news conference in front of us, and Jackson Hole, the annual get-together in Jackson Hole, Wyoming, about a month away. With us around the table, I'm pleased to say the former Fed Vice Chair, Richard Clower, is with us. Still with us is Bob Michael of JP Morgan Asset Management. Rich, it's good to see you, sir. Let's start with you. You listened to Mike, you saw the changes in the statement. What do you make of what we just heard?
Well, I'm a bit surprised, actually. I mean, not with the adjectives. They needed to change some adjectives up, but I was a bit surprised about the reference to the attuned and attentive to the balanced outlook. I mean, that's certainly correct. The chair's been making that point, but I think it is relevant that they included it in the statement. He will certainly, I think, reinforce it in the press conference, and I do think it does tee up Jackson Hole. There'll be some more information before then.
I look at, and this show's the best one we've ever done. We've got Dudley with this important Bloomberg opinion piece a number of days ago. And I want to go to you on what you own, which is the high ground on the ex-ante, ex-post debate. You've got the Economist magazine article you did a year, whatever ago. You got your January 2022 context and consequences speech. You want an ex-ante aspirational Fed. I don't hear that here. They're waiting, they're waiting, they're waiting.
They are waiting. I think they are getting greater confidence. But I think the key point, not to toot my own horn, is my view all along.
But it's okay. It's surveillance. You can do that.
My
Farrell
view
does
all
it all
along,
day.
and I think I've said so on this show, is that the Powell Fed, really the goal was to get inflation to 2 point something, and then they would start thinking about the next step, which would be easing, not running an easy policy, but removing restrictions. So I do think this is what we're seeing. And if we do get the cut in September, as I think we and markets expect, it will be because they expect inflation ex-antes to continue to fall.
But are we anywhere near that? I'm sorry. This is an ex-post Fed going back to Arthur Burns. They're as data dependent as I've ever seen.
Yeah, they are data dependent, but I think that they attenuated and focused on the statement today, emphasized both sides of the mandate. So I do think they're looking at just the labor market as well as the inflation data.
Bob, what's your take on this? It seems like it's less dovish, a little bit more balanced than you initially thought. Do you think this just is trying to move as incrementally as possible?
I think they preserved full optionality heading into Jackson Hole. I also think that central bankers are mindful of what happened to the ECB earlier this year, where you could have made the same argument. If you're going to go next month, why not go this month? And then, of course, you saw what happened. So I don't see too much different than what we expected, other than they just decided to maintain the full optionality. We'll see what happens as we roll into September. We're still very much expecting 25 basis points in September.
Neil Dutta of Renmark just writes in, publishes, with language like this, it means the Fed will have to make a more pronounced shift in language in September. I'm surprised stocks are holding up well on this statement. Perhaps equities are looking ahead to the news conference. The news conference starts in about 24 minutes' time. He goes on to say, the Fed is waiting for additional data. Can they even articulate why inflation might re-accelerate from here? Can we pick up on that question, Bob? Can you articulate the risks around inflation? Why might it re-accelerate from here?
Corporate profitability still looks great. We talked about S&P 500 earnings. They're coming in ahead of expectations. You look at the guidance companies are giving you. They're up 12% next quarter. So we're not in a recession. We're slowing down in some parts of it. We'll see. You know, I can't find really the argument what's going to cause inflation to reaccelerate, to be honest.
Well, Rich, we were talking about how this was definitely going to be unanimous. And I wonder how much of a wrangling of cats there is in the room and whether this is basically a representation of that there's some members who believe that inflation has been killed. It is nowhere in sight, that labor is important. And then you have others who say, well, you know, wait for the year-over-year comps. Is that kind of what we're seeing here?
I think it could be an element. You know, we've had some members of the committee, and I know most of these folks, but it's a different committee than the one I was on, and many of them do emphasize both sides of the dual mandate. So I'm sure that reflects a number of folks' views. I do think, though, this is a committee that certainly got burned earlier in this year because the inflation data went the wrong way. And to their credit, they became very data dependent, as Tom indicated. I think that they, put it this way, I think they think they're going to go in September. There is a range of data where they wouldn't, but I think it's a pretty small range. And I think that's really the balance they're trying to strike. And I think we'll hear that in the press conference.
We were speaking earlier with James Bullard, formerly of the St. Louis Fed, and he was talking about how he always raised the question at meetings that if you wanted to cut rates, most certainly at the next meeting, why not cut them now? Bob was sort of discussing that earlier. And it sets up this sort of difficult period of time where every data point could potentially upset the apple cart if it doesn't comply. Do you think that they are in that zone right now?
I don't really. I mean, I've certainly, during my time on the committee, we found ourselves there a couple of times, so it can happen. I think the data we have gotten, you know, the chair did a lot of communication before a blackout, and the data since then has reinforced that view. So I think there's a pretty wide range of data where they'll feel comfortable going in September. So I don't think they're in that danger zone.
Can you confirm that Jim actually said those things at the FOMC meeting?
Well, of course, I would never reveal what was said in an FOMC meeting except what I say, all the brilliant things I said. So.
Diane Swonk joins us now from KPMG, alongside former Fed Vice Chair Rich Clarida and Bob Michel of JP Morgan. Diane, I want to get into this statement that came out about 8 minutes ago. What do you make of it, the incremental changes, and were you looking for something bigger?
I wasn't looking for anything bigger, and I think one of the key issues here is we saw Powell talk about in his congressional testimony when pushed on the dual mandate. He said, listen, this is the thing that keeps me awake at night. The number one thing that keeps me awake at night is that overshooting, the over-tightening. So that is in there, and that is what opens the door a crack, not wide open, which is what we expected for September. And I do think they're going to move in September, and I agree wholeheartedly with Rich on this. I think the other issue is there's sort of this tale of two economies we're seeing emerge out there. The one that's in the household survey that's close to but not yet triggered the Somm rule, which is what got Bill Dudley up in arms, and how weak employment has been in the household survey, and the establishment survey, the GDP data, other jobs data that suggests the economy is still on solid footing. And right now the Fed has been opting into more of that establishment survey where payrolls have held up, although they're not quite as strong as they've been. We're going to get probably some good public sector hiring in the jobs numbers on Friday again, which will help buoy those overall numbers, adding to some weakness in the private sector. But I think that's important, is that the Fed is looking at this and they're weighing which is the right stuff, and really getting to Rich's point too. There isn't just one piece of data that the market keeps looking for that could tip the apple cart. The Fed is looking at the totality of the data, and that last line really gets to that point. The totality of the data will allow them to go in September, and they don't want to make the same mistake the ECB made, move and then have to freeze and be in a purgatory. Their credibility is at stake. They want to make sure inflation is coming down, but I agree with Rich, they'll still cut before inflation reaches its 2% target, anticipating that the economy, by lifting off that restriction, the economy will get there.
We have Swonk and Clarida with us. Bob Michel, maybe a question for you on the economics of the moment. Are we slaves to measured? We have measured for decades. We're being very measured where maybe other central banks aren't. Are we just so afraid to move, and we're over careful, over cautious, because once we move, we've got to move in a measured vector?
I feel like we're back to the Greenspan Fed, where every word is so carefully thought out. it makes you want to overanalyze it. And no one can give an inch. If the wrong word is in there, then the FOMC gets concerned about the market pricing in hundreds of basis points of rate cuts and risk assets being up tens of percent.
Okay, please go.
But we're talking about, and Rich touched on it, we're in, I think, very restrictive range. 25 basis points, you're not in a loose monetary world with money flooding all over the place. You're still restrictive. You've got to start that journey somewhere.
This is too important. Lawrence Meyer, Washington University, his monograph, A Term at the Fed. He tore Greenspan apart, that it was a dictatorship. Are we getting to the point now no one can dissent and everyone's measured because we're measured and appropriate?
No, I think no one has dissented because 2 years ago inflation was too damn high and they were all agreed they wanted to get it lower. It'll get more interesting as we get close. But what I want to say, to invoke the Olympics now, this is a Fed that really wants to stick the landing. You know, they won't say this word, but their projection and what we're seeing in Bloomberg consensus and elsewhere is a soft landing, and they want to stick it. And, you know, the data is now solid, it's moving in the right direction. And so, you know, getting back to the Greenspan Fed, there was a soft landing or so in those years. Alan Blinder has written, they're not, you know, common, but we do see them. I think in 2019, I think the Powell Fed got a soft landing. We don't see it in the data because we got the pandemic. The economy looked pretty good in January of 2020. So they're trying to stick the soft landing.
Forget about sticking the landing. Let's just throw them in the Seine. The water's fine. You'll be okay.
You win. Better analogy.
All right.
Okay.
There's another analogy. Matt Hornback puts this out earlier, and I'd love your thoughts on this, Diane. Basically, the Olympic motto, to carry on with this, reads faster, higher, stronger together. Could have been used to talk about central banks globally altogether. Now, it might be more apropos, slower, lower, weaker together. Diane, how much is that looming over this Fed meeting? The idea not of synchronized swimming or synchronized rate cuts, but this idea of trying to sort of take an edge off for the rest of the world that really does seem to be dealing a little bit more with some negative growth.
I don't think that's the Fed's main concern, and I'm sure Rich will back me up on that. I remember seeing Ben Bernanke actually go after another central banker who said, you guys need to change your policy to help us out. And he said, that's not our problem, basically, at a Jackson Hole meeting. So that is not the Fed's primary concern. That said, a strong dollar helps us out down the road in keeping goods prices lower, so that helps the Fed out. I think what's more important here in terms of the Olympic analogies is that the road to gold is often paved with tears and obstacles, and I think people forget that. And I'm thinking of Simone Biles here. I'm sorry, she's my hero and heroine at this point in time. But I'm thinking about, you know, soft landings. People forget that the 1994-95 situation, it looks great on paper. I lived it. I remember it. Rich, you lived it too. It was ugly at the time. Chairman Greenspan's reappointment as his third term as Fed chair was held up for 4 months in 1996 because he nearly crashed the economy in 1995, and people were so angry at him for not easing sooner. And it was his own colleagues, including Janet Yellen on the Fed, that got him to experiment with productivity growth and intense foreign competition, that bringing down inflation and allowing the unemployment rate to fall instead of using monetary policy to do it. That is really important to remember, is that soft landings are not easy. They look good on paper, but getting there can be a hard path.
Diana, where does the confidence come? Where does it come from that unemployment stabilizes at these levels and doesn't carry on shifting higher into year end? What underpins that?
Well, I think, I don't know if unemployment is going to stay there or not. It often moves up slowly and then moves up rapidly. All I know is that even Claudia Sahm, who wants the Fed to cut right now, has argued her own rule might not be applicable in the post-pandemic economy because of all the changes we've seen. We've seen much of the rise in unemployment has come from more people seeking jobs, an increase in the participation rate, particularly among prime-age workers. We've seen an influx of foreign workers, foreign-born workers, accounting for over 70% of the growth in the civilian labor force since February of 2020. That's helped to buoy the unemployment rate as opposed to a surge in layoffs. That doesn't mean there aren't stresses in the labor market. That doesn't mean there aren't still problems. But at the end of the day, what is it that people complain most about? They can complain most about the high level of prices still. And that's something that the Fed also has to keep in front of its mind. And I think that's where we're at. At the end of the day, we don't want to lose this and not hit that soft landing, but it's a rocky road to get there. I think we're still going to make it, given the fact that we saw the positive of consumers push back in the second quarter on price hikes, and retailers and producers capitulated. They rolled back prices on goods, and we saw a rebound in growth, doubling the pace of the first quarter, driven in large part by a rebound in consumer spending. That's the Goldilocks scenario towards a soft landing.
There's this issue, Bob. We're looking at market pricing, and right now it seems like this is consensus, that they are going to land the soft landing, even though it is sort of a rarity or a white elephant. Do you think that the market has overpriced that soft landing, or even underpriced it because the internal skepticism just keeps on roaring?
No, I think the markets are right on track with the soft landing. And if it in fact happens, the Fed can bring down rates a fair amount, and the markets will continue to appreciate. I think what's different this time is the Fed and investors have a lot more real-time information. I was around in 94, 95. I was around in 81. And you didn't have that information. And now you have it. It's real time, it's live, you can see what's going on. Businesses have it, households have it. And maybe it gives policymakers a false sense of comfort, but they have that sense of comfort.
Which really kind of leaves the market kind of in the way, sort of in the same boat that the Fed is in. And I wonder, Rich, you know, if you were still on the Fed, how much the Fed looks at the market to kind of gauge progress, sort of follows them, if you will, because they are gauging real-time data. And if anything, this is the collective will. And I love the war stories from the mid-1950s from everybody. But I wonder if, you know, if that's something that they could really kind of sink their teeth into.
Oh, sure. Well, I mean, I'll just speak for myself, but you're looking at the market, hopefully to try to extract signal. There's always noise. You have to be honest with yourself. But it's particularly relevant for things like the growth outlook and the inflation outlook. You need to know what is being expected. That's a key input to monetary policy, our expectations. I gave one of my speeches at the Fed was on this point of avoiding the hall of mirror problems by looking at market prices. So I'm not saying it's easy, but I don't think there's an alternative.
I want to cross back over to Diane. Diane, I know you've got to go in a second. Just a quick final word. A question for Chairman Powell in this news conference, Diane, what would it be?
Well, this is on communications. I think it's going to be very hard for the Fed to communicate. We've already seen financial markets are trying to front-run the Fed on a larger cut in September. Yeah. How do they calibrate their communications to deal with what may be more measured cuts?
Interesting. Diane, thank you. As always, Diane Swankler of KPMG. If you are just joining us, welcome to the programme. The Fed decision came out about 20 minutes ago, unchanged on interest rates, and the statement largely unchanged as well, just some incremental changes. So the focus on the news conference now, which starts in about 10 minutes' time. With us, joining us now, I'm pleased to say, is Mike Gapin of Bank of America. Michael, going into this news conference, very incremental changes in that statement. Were you expecting more than what they delivered?
No, I wasn't. I think with the strong growth numbers we received, the right place for them to make adjustments is exactly where they did. Reflected a little bit in cooling labor market conditions, reflect a little bit more progress on inflation, kind of pin down and nail down that balance of risks argument, because that's what the chair had said in front of Congress. So I think this was the right incremental move. I think the Fed feels that it's in a sweet spot right now, that the data's moving in its direction, so it's getting closer. It just needs a little bit more, and then that confidence, that nebulous confidence may be there. So this is what we were expecting. We weren't expecting a big lean in either direction from the statement.
The market, as you know, Mike, has been looking for September and a baby step towards that. You and the team have been looking for December. What separates you at the moment, Michael, the data that backs up your view, what separates you from the rest of the street at the moment?
Well, I'd say we have less concern about downside risk to the economy. We certainly are watching for it and looking out for that we may be wrong on this view. But the economy grew at a pretty solid pace in the second quarter. And yes, things are moderating and cooling, but I still think that there's a lot of resilience to both the economy and labor markets, and we'll see. Maybe there's a little unevenness in this inflation story. But certainly a September cut has moved a lot closer to our baseline. So yeah, we're still in December, but we've got 2 employment reports and 2 inflation reports between now and then. Further progress in those 2 variables, a little bit weaker employment, kind of repeats of what we just saw in June inflation, that could easily put a cut on the table in September. So September can happen, but it may not. So I think that's how I'd frame it right now.
Michael, let's just put a bow on this. What does further progress look like to you in the 2 labor market reports and the 2 inflation reads that we get until the next meeting?
Well, I think the labor market report is maybe a little more asymmetric. A strong report's probably not going to prevent them from cutting, but obviously a weak one could. So if they feel the labor market is softening more than they expect, they could go in that regard. Otherwise, I think to your earlier question of what's going to cause inflation to rise, I can't see it. I agree, but I don't think what they can rule out right now is that inflation settles in at a level that feels a little uncomfortable for them. So I think on the margin, a little more evidence that no, we're not going to get stuck with, say, core PCE in the high 2s. It does look like it's moving lower. So 1 or 2 more reports that give them confidence about that, then I think is probably enough.
Speaking of discomfort, we know a topic they're uncomfortable with, and that's politics. And if it comes up in this news conference, we know what Chairman Powell's going to do. He's going to ignore it. But there was a letter sent to him by Senator Warren and company. And TK, there's a quote in this letter. The immediate press release read as follows: "The failure to cut rates would indicate that the Fed is giving in to bullying and is putting political considerations ahead of its dual mandate to promote maximum employment and stable prices." So you've got the Republicans saying if you cut rates, it's political, and you've got the Democrats saying if you don't cut rates, it's political. Sort of stuck in a rock and a hard place between the both.
And what's important here, John, it's so important, is that Richard Clarett is one of the people that brought history back to economics with his work at Columbia. I sat at the Fed with you in that magnificent library of first editions, and Elizabeth Warren reached down and said, take the book off the shelf, and I took Torsten Veblen, The Theory of the Leisure Class, off the shelf, and you and I were talking about it. This is a few years back. That's what Senator Warren's talking about, is the Gilded Age. Are we in a Gilded Age where the elites are talking only to the fancy people and indirectly doing monetary policy only for the fancy people?
Well, no. In one word, I think the Fed has the dual mandate. Inflation was too high. They're focused on both sides. I think the economy's in a place where it can certainly adjust and wait another 2 months until the cuts commence. So I would push back on that.
Mike Apen, would you push back? Just how relevant is the U.S. election and U.S. politics?
Well, the way I would frame this, and I think Rich would agree, I was formerly on staff at the board, and I learned quickly that no matter what you do or don't do, somebody's going to be upset, and one side will complain or the other will complain. So I think you learn quickly the best thing to do is to do what you think is right. So I would put it at that. So they have competing opinions here. The right thing to do is to do what they feel is right.
Mike, I'll finish with the same question I finished with Diane Swong. Questions for the chairman. If Michael McKee's listening, going into this news conference, what's the #1 question for you?
Well, the chair has said that they could ease if there's unexpected weakness in the labor market, which is actual data that comes in below their expectation. But what about preemptive easing on the risk of labor market weakening? I think that might get at the gap between market pricing and what the Fed thinks it will deliver. Mike
Apen, thank you, sir. Michael Apen there of Bank of America. The news conference about 5 minutes away. Bob, there is a question here about what kind of interest rate cut it would be when we get one, if we get one, in September. Is it a risk management decision? Is it a mid-cycle adjustment, the beginning of something much bigger than that? Do you think they have to frame it at this point? Do you think they have to characterize what it might be?
I think they do, and I think they'd like it to be part of the normalization process, that they've achieved their targets on both sides of their dual mandate, and they could start to bring down what is a restrictive policy.
Michael Gapin echoed your speech of January 2022. It's about ex-ante aspiration. I don't want you to voice for the chairman. I know that's inappropriate. But how does he voice the aspiration of getting out front here in 6-7 minutes?
Well, I think he'll stick to the mandate and he'll stick to documenting the progress. And again, he won't use the word soft landing, although that's, I think, what they're trying to achieve. And I think Governor Waller's done a very effective job in his many speeches in making the point that they have time because the data is holding up quite well. You know, it was a very bold call a couple of years ago for Waller to say we can disinflate without this huge pain in the labor market. I think they were prepared to take it if it was required. It hasn't happened. And so now I think they're even more focused on the soft landing. And I do think they do want to avoid a premature declaration of mission accomplished, because even if underlying inflation is going to target, there's always noise in the data, and 2 or 3 months of noise on the wrong side is a bit uncomfortable.
Rich, there's this feeling baked into markets that Fed Chair Jay Powell is much more dovish than the statement might suggest. Are you expecting that tone to kind of come out in the news conference?
Interesting. You know, we heard a lot from Chair Powell at Centra on Capitol Hill, sitting down at the Economic Club of D.C. I've gone through and looked at that. I would actually expect him to stick pretty close to that, which was very balanced, not declaring victory, but acknowledging progress, emphasizing, as the statement does today, that they are really attuned and attentive to both sides of the dual mandate. You know, so there are some times where I think the press conference is really the chair using a lot of, this is what I think. I think we'll hear a lot of this is what we think today. I think the committee's pretty tightly aligned on where they are.
Bob, what are you listening for today?
I actually think he will come out a bit more dovish. I think that's the way he's rolled the last several meetings. He's surprised us by deviating from the script and indicating that, yeah, you know, he could see rate cuts on the horizon. I can't take my eyes off of the last sentence in the second paragraph, where the committee is attentive to the risk of both sides of its dual mandate. I got what I wanted, at least, which is acknowledgement of risks in the labor market. The more I look at that, the more it's clear to me that they're going in September. If I were Mike McKee, a lot of people tried to press the Fed on what their neutral long-term rate is. I would ask him, at what level is the Fed funds rate no longer restrictive?
Do you think they can answer that, Rich?
Well, I think they won't answer that. I think they have and this is one where there are probably 19 different opinions on the committee. One thing I'll say a little bit is right now, as I look at my Bloomberg screen, or I did 25 minutes ago, September was more than 100% priced in, and even I wouldn't say it's 100%. There's data we could get between now and then where they might not go. So that's why I skew a little bit to being a little bit more balanced than maybe dovish, but you know, we'll find out.
I'm pleased you brought up Sintra Portugal, because I think it's really important to reflect on the comments from Chairman Powell back in Sintra Portugal at the ECB's annual get-together. Chairman Powell was talking about the strength of the labour market, and the strength of the labour market being a reason for them to wait, that they have time. They can wait and see, a few more months of data maybe. And it's his characterization again in this news conference of the labour market that I think matters, off the back of that incremental change in the statement that you're all picking up on around the table, that last line of the second paragraph. You've seen this incrementally in the Fed speeches over the last few weeks, Lisa, the last month. They're placing greater emphasis on the other side of the mandate in a way that it wasn't even part of the conversation a year or so ago. Think about where we've come from. 2 years ago, Jackson Hole, August 2022, pain to get inflation down. The focus was getting inflation down. And you can start to hear the focus shifting to the labour market. Let's take a listen to the chairman of the Federal Reserve, Chairman Jay Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment, and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy, and potentially very restrictive policy given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about you know, that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. You know, we've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was, you know, a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be, you know, a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris. Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as, you know, we're actually in a good place here. We're balancing these two risks of, you know, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, And, we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market has, I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most rate, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell with Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're reporting too low inflation. If you smoothed it out, it's a zero-sum game, and that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12 month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting job inflation sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year, and the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. We get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Thank you, Mr. Chairman. Edward Lawrence, Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports in the last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We said, we pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got another quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee, but it's a conversation that we had today, certainly.
Courtney. Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. Just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the Sahm rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more, it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of admittedly very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amara. Thank you, Chair Powell. Amara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent Downbeat Beige Book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the Beige Book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the non-profit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are it's just difficult to do. So I look at both. Yeah, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings, and all of our decisions are focused strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. You know, we basically, we have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. You know, we're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and you know, we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. You know, no one has a veto. You know, no single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that, you know, we've felt more united because we felt, you know, under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean. Hello, Jean Young with MNI Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
You know, I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, you know, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that, and then we have an opportunity to comment on that. Then we have an economic go-around, and then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this, and you know, there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy, and so. In the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and But I do think that, we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly, the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That, as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market. So that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on that, on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan to. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
That wraps up the July Federal Reserve News Conference with Chairman Powell. If you are just tuning in, welcome to the program. Let's wrap that up for you. This market got the dovishness it wanted to hear. The equity market's positive by close to 2% on the S&P 500. On the Nasdaq 100, up by 3.3. We're moving closer to cutting interest rates. September could well be on the table. Push that through the bond market, a fifth consecutive day of gains for the 10-year Treasury. Yields lower. We're down by 4 basis points on a 10-year. It's a break of 4.1%. So we've all got the same question, just how low is the bar for a rate cut in September? This is what the chairman had to say.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So let's talk about the calendar. The next meeting, September 18th, the data in between. August 2nd, this coming Friday, payrolls. August 14th, a CPI report. September 6th, the jobs report. On the 11th, another CPI report going into a Federal Reserve decision week. And most people assuming after that, Lisa, we're like this far away from that interest rate cut.
Especially at a time where there was a different type of language in this communication. We are not data dependent. They are data dependent. They're not data point dependent. They want to draw a distinction that one data point isn't going to throw them off materially. They repeated the totality of the data, as well as how they just need to see the same kind of good data that they've already been seeing.
The time continuum to me was critical. I thought Steve Leisman's question was great about measured. He alluded to this. They're slaves to measured, John. That's all there is to it. I just don't know what else to say. I'll talk to Dudley about it here. To have Clarida and Dudley with us today is
fantastic.
It's just lights out. And I really, for those of you at Global Wall Street, what's coming up here with Dr. Dudley is required listening.
There was a fantastic line that came from Evercore's Krishna Gua. I want to share this quote with you. He thinks they've laid the foundations for a rate cut in September. I think a lot of people observing that news conference would agree. But this quote's interesting. We think in practice it's not very data point dependent, and view the cautious evolution of the statement as intended to carry hawks along and avoid dissents, as was indeed the case today. Expect a clearer signal a month from now at Jackson Hole. I'm thinking about the minutes as well. I just wonder how well set the stage is for the Doves to dance and sing very loudly in these minutes that come out in a number of weeks' time.
I was very happy that the reporter asked him to elaborate on the fact that at this particular meeting, they did discuss the possibility of cutting rates, that there were a few members, but not the vast majority. Here is the question. How loud was that voice, and what did they have to give to those people to get on board with them in terms of this decision?
As you bring in Dr. Dudley, moments ago, the 10-year yield broke down to a 408.92. It's a new low yield. Can you imagine, John, what our shows are going to be like with a 399 10-year? I can't get there.
Where are we going to be in September? Where's the unemployment rate going to be in September? That's the big question I have going into the payrolls report this Friday. Bill Dudley got a shout out in this news conference. Bill Dudley joins us now, the former New York Fed president and Bloomberg opinion columnist as well. Bill, I want to go to your column that you wrote in the last week or so. It was quoted in this news conference. I'm sure you heard it. What did you think of the chairman's response to it?
I thought it was a fair response. I mean, this is my opinion, and the Fed is reaching a slightly different opinion. I mean, we're at a point where the risks are pretty closely balanced, and so the question is, do you go a little earlier or do you go a little later? I think, the reason why I thought it made more sense to go is that if the market's already pricing in September with a high degree of certainty, what are you really waiting for at this point? Why take the additional risk of, the economy deteriorating further? So, at the end of the day, it's probably not going to make a big deal, a lot of difference, but I think, given the fact that the market expects the Fed to cut, once that decision is mostly made, and I think you heard today it was mostly made, then why are you waiting?
Bill Dudley, your essay heard around the world, the single sentence, the Fed doesn't want to be fooled again. You've held court at Princeton, where the late, wonderful Daniel Kahneman held court. Here's Kahneman with Tversky. Decision makers know they are prone to regret, and the anticipation of that painful emotion plays a part in many decisions. How is regret aversion playing in to this massive data dependency ex post ballet?
Well, what may be happening here is the fact that they got fooled on inflation, early this year, where the data came in bad, makes them, overly cautious that they're going to make this, that they could make the same mistake again by going early. I think it's, economists talk about recency bias. You put too much weight on the most recent experience. So this may be a case where they're not putting enough weight on the fact that, things are slowing and the inflation's coming down, and maybe now's the time to act. I think it was interesting. You got a question about the Somm rule, the fact when the unemployment rate climbs above 0.5% on a 3-month moving average basis, you always have recession. He said he's aware of it, but clearly the Fed doesn't put a lot of weight on that risk.
Do you feel like we're getting closer to the moment where we will see real dissent on a committee that's being cobbled together, and you can kind of feel the strains in some of the communiques?
No, I think what happened today was basically the Doves got a pretty dovish statement and a pretty dovish press conference, and so they're sort of set on board, and the Hawks got more patience. And so when you arrive at the September meeting, assuming the outlook doesn't change in a material way, and that's basically what Paul was saying, it's not about a single data point. The outlook has to change in a fundamental way for the Fed not to go in September. At that point, you have something to basically give to both the Doves and the Hawks. The Doves, thank you for being patient. The Hawks, we waited, so let's go together unanimously at the September meeting. So I think there's a good possibility that you'll see a unanimous vote at September for a 25 basis point rate cut.
Bill, you brought up the Somm rule. The chairman also brought up the yield curve in this news conference as well, and highlighted the false positives we're getting from traditional indicators. Just to reflect back on that piece that you wrote for Bloomberg Opinion, can you walk us through why you do think actually the Somm rule does matter? That maybe we should have a little bit more of a focus on these traditional indicators still, and not completely ignore them?
Well, if I can start with the yield curve, the reason why I don't think the yield curve is necessarily a good predictor is the yield curve is inverted because people think monetary policy is tight. So it's not the yield curve shape that causes the economy to weaken. It's the presumption that monetary policy is restrictive that causes the economy to weaken. Most of the time when the yield curve is inverted, monetary policy is tight, and so the yield curve is a good predictor. The Somm rule, I think, is a little bit different. It's basically saying once the labor market deterioration goes beyond a certain point, it becomes self-reinforcing. Essentially what I think happens happens is households hear about the labor market weakening, they pull back on their consumer spending. That causes businesses to pull back in terms of investment and hiring, and that leads to further weakness in consumption and then further rises in the unemployment rate. It's a pretty amazing statistical regularity that either rises less than 0.5% or next stop is a full-blown recession. There's nothing in between. The smallest increase in the unemployment rate, trough to peak, is either between 0.5 and 1.9 percentage points. There's nothing in the middle, which I think is pretty interesting statistically. Now, he did recognize that as a statistical, just a statistical result. There's nothing there's no economic law behind it, but the track record is 13-0. So, think about the odds of flipping a coin 13 times and coming up heads every time. After a while, you're sort of going to believe that the next flip is going to generate the same result.
Bill, take us back to first principles. Why can't they just cut and say one and done and we'll observe versus our addiction to measured?
Well, I think what will happen is once they start to cut, they'll probably keep going. Once they start to do the first rate cut, they basically decide that monetary policy, that we've accomplished our mission in terms of inflation and unemployment. Policy is restrictive, so we now have to go back to neutral. Neutral's not 25 basis points away. So if you have a rate cut in September, it's probably going to be followed by rate cuts, at least one or two more rate cuts later this year.
Bill, it seems like this was a setup for Jackson Hole. We've been talking about that. And it seems like there will be some sort of policy regime shift that we will observe in August. What do you think it will be?
I don't think that Powell really needs to say much more than what he said today, frankly. I think the changes in the statement and the press conference today basically tell you that September is going to happen unless the economic outlook changes materially. Now, that's possible. You could get a whole string of bad inflation numbers, or the economy could come in hot. But I think in the next 6 weeks or 7 weeks, is the outlook going to change materially? I doubt it. So I think regardless of what happens in Jackson Hole, I think the Fed's going to cut in September. I think Powell will sort of check in at the Jackson Hole and basically, probably confirm that we're still on track for this result for a rate cut in September. But I don't think it's I don't think he has to use it for that.
Well, although it's not just about September, it's not just about whether they're going to move again one more time this year. It's about what the destination is. It's about the pace. It's about what the goal is in terms of just the view of where the economy is. Bill, do you expect there to be any discussion about the terminal rate, about what it means to be neutral at a time where this is a very different economy than pre-pandemic?
Well, I would assume that once you get inflation, you're highly confident inflation is going back to 2%, and you think the labor market's in balance, then presumably you want to go back to a neutral monetary policy. And the question is, what's neutral? And that comes down to that whole question of what is the level of R-star, the neutral federal funds rate. I think that neutral is clearly, lower than where we are today, but is it 100 basis points lower or 200 basis points lower? That remains to be seen. So the Fed's going to be sort of feeling its way. Now, obviously, if we fall into recession, then the whole story changes. Yeah. Because in a recession environment, the Fed doesn't want to go to a neutral monetary policy. They want to go to a stimulative monetary policy. So if we actually, if it turns out with the benefit of hindsight that the Fed is late and we have a mild recession, then the Fed's going to cut rates much more dramatically.
Bill, I've never said this. I've got Dudley, Krugman, and Blinder on the same page. Never did I think I'd say that. The money paragraph from your good friend Alan Blinder. Any such early cut should be accompanied by a warning not to expect a steady stream of rate cuts. He alludes to the ECB. Do we need some ECB religion at the Eccles building?
No, I think that the Fed will probably cut more than one, because once you start to cut, you're basically saying, I think it's time to remove monetary restraint. And monetary restraint is not going to be removed with just one 25 basis point rate cut.
Bill, great to get your thoughts. Appreciate it. Bill Dudley there, the former New York Fed president, weighing in on this Federal Reserve decision, as he got a lot of people talking over the last week about the need to move in July at the meeting that's just passed. I want to bring you a headline. Comes from the New York Times, and it reads as follows. Iran's supreme leader ordering a retaliatory attack on Israel. The New York Times citing 3 Iranian officials briefed on the order. This is what I can tell you about crude. Crude's been rallying all day, and the price of crude looks like this at the moment. Brent crude up by 4 percentage points. TK, you would often say overtaken by events. The last thing this Fed needs over the next month or so is an energy price shock.
I'm so glad you brought this up, Jen. We led off the show this morning with Ethan Bronner, our Tel Aviv News Bureau chief, encyclopedic on the region, and he says the position here now is unprecedented, and he made clear there's going to be immediate news following both from the north to Lebanon and the news that you just have from Tehran as well.
As we get those updates, we'll bring them to you. I just want to reset. If you are joining us, we've just had a Federal Reserve decision in the last couple of hours. Interest rates unchanged. Incremental changes to the statement. There was a sense that in September, the Federal Reserve Chair would set us up for a rate cut in September. He took a baby step towards doing so, and the market picked up on things accordingly. Big rally across equities, on the Nasdaq, on the S&P, on the Russell. It looks like this right now. It fades just a touch, but we're still higher by 1.4% on the S&P. Bear in mind, the Nasdaq was poised for the worst month of the year, and at one point in the last couple of hours was on course for its best day of 2024. That fades. We're back down to about 2.7% higher on the session on the Nasdaq. We referenced this stat a little bit earlier on today, a few times. We are now on course for the 7th consecutive Fed decision day rally on a 2-year bond. Lisa, that yield is lower by 6 basis points.
How much is this just that Jerome Powell tends to skew dovish, and how much is this that the market still has a probability or a possibility baked into what the yield is that the Fed could maybe surprise in a hawkish manner? Either way, this is a market that likes to hear Fed Chair Powell speak, and today was no different.
Mike McKee was in the room with the Federal Reserve Chair down in Washington, D.C. He joins us from the nation's capital now. Mike, you've just got outside. Walk us through your biggest takeaway from that news conference this afternoon.
Well, I think what you walk away with is what Bill Dudley was talking about. If the economy doesn't do something weird, change positions, change directions, then the Fed is going to be cutting in September. But there are a lot of potential twists and turns between now and then. Friday is event risk with the jobs report. And of course, you just mentioned the situation with Iran. I don't think the Fed was taking those things into consideration today as reasons not to move today, but they do have to worry about them and what might happen. Right. So they will, at this point, be on a cutting course unless something significantly changes. And I think that was the message that Powell wanted to deliver. And I think Bill put it well when he talked about how the statement was skewed to the doves a little bit, and the news conference maybe to the hawks, and that both sides get something out of it.
Mike, you've been doing this for a few years. Back to McChesney Martin. We almost printed a 406 10-year moments ago. Can the bond market tell the Fed what to do?
Probably not. And one of the things that you have to keep in mind is that we have all this international news going on, and the U.S. bond market is the haven market. So a certain amount of what's going on today is probably in reaction to Israel and Iran, and a certain amount of it is the politics going on in this country. And then on top of that, what the Fed is considering and what the economic data are showing. But I suspect today's less about the Fed and the data than it is about other things, because the market had pretty much priced for a September rate cut. They didn't get any surprises out of the Fed today.
Mike, you're referring, of course, to the news that John broke about Iranian supreme leader ordering an attack on Israel for the 2 assassinations that Israel carried out. Right now, we're seeing crude markedly higher, particularly Brent crude. Mike, I wonder how this relates to what Fed Chair Powell has been talking about, that this is actually better inflation data today than it was, say, late last year or earlier this year, simply because it is not being driven by goods. It is being driven by the employment market. It is being driven by services. How much do you believe, based on those comments, this is a Fed that is willing to look through good side inflation and focus much more on something else?
Well, I think they are, especially if oil prices go up only temporarily. The problem is if oil prices go up for quite some time, then that feeds through into the real economy, particularly on the services side. You'll see surcharges by delivery companies, airline fares might go up, that sort of thing. So they're going to have to keep an eye on that. But their general instinct would be to look past any kind of energy price change that comes about that they think might be temporary. And at this point, we have been waiting for a major shift in energy prices since October 7th, when the first attack on Israel came. So we haven't seen it yet. Let's see whether this holds or not. And then the Fed would have to take it into account if it's still going on.
5% rally in crude today. Mike McKee, great work as always, sir. Appreciate it. We'll catch up with you a little bit later. This week's not over. Still got some work to do. The Fed decision behind us. Tomorrow we'll get jobless claims. On Friday we'll get a payrolls report, and we'll be catching up with Jeff Rosenberg of BlackRock. We can do that now. Jeff, at 8:31 on Friday, will this decision today to do nothing, will that look like the right one?
Well, you know, it might look like the right one, but I think the point you're also getting to is that Friday, and we'll see on Friday as well, is going to be much more consequential. But I think the important point about how it's going to be more consequential is what we've heard from everybody so far, what we've heard from the chairman, and in the statement is this is very much setting the table for September. And the bond market had already priced that outcome. And so what you look at into Friday and the payroll is you're setting up the bond market, perhaps broader markets, for a very asymmetric outcome. If the data is much, much stronger, then you're going to have some disappointment. If the data comes in along lines of what Chairman Powell was talking about in terms of gradual normalization, or even, you know, a little bit weaker than that, the market will continue to price in this path of a cut in September, a cut in December, and even more into 2025. So I think Friday, the risk is really on the upside, that you get a surprisingly strong payroll report, and that has to call into question whether or not policy is really as tight as it is. And that's really the issue. Everyone's kind of saying, hey, this is right, the Fed's got it right. The Fed's saying we've got the soft landing, we want to secure the benefits of soft landing. But he kept repeating PDFP at 2.6%. You look at the GDP number that just came out, you look at Atlanta Fed GDP Now forecast for third quarter. We are well above, in growth terms, anything associated with long-term sustainable growth. And so, yes, we've seen some signs of restrictiveness, but how much of that
Hold up,
restrictiveness?
Jeff, because you're
and that's where
going
the asymmetry
totally
comes
against the grain, totally against the grain. And I think you know you are. Most of the people coming on this show right now, if they're going against the Federal Reserve, they're saying it's because they think this Fed is too tight, not restrictive enough. You're making the point here, Jeff, that maybe they're not as tight as they think they are. Now, that really goes against the grain, Jeff. Is that the point you're trying to make?
That is the point exactly that I just made. No one's really talking about it because the Fed's not talking about it. But the data is what your question was about. What happens on Friday, and how does that make this moment look? Well, if the data comes in continually stronger, then we're going to have to start to talk about that. Now, I'm not saying that that's where we're going. Where we have been, and what we tend to do, is to extrapolate where we just have been. So we're extrapolating out the benefits of the gradual slowdown in labor markets, the normalization. ECI is another great data point. There's nothing in the crystal ball that says that that won't happen. But your question was, what if it does? Then you start to think about these things. And my point is, everyone is so one-sided on this point that the asymmetry to the market reaction is much greater to the upside surprise and strength on Friday than it is to coming in line or even being weaker.
So let's put a call around that, Jeff. Are you basically selling two-year notes right now, trying to lock in because you think that this could be the highs, given that they are not recognizing the risk of an upside surprise to the jobs report?
No, I wouldn't say I'd go that far, but what I would say is it tempers some of the enthusiasm for adding to 2 years at this point, when it's all in the price, and even more so relative to what the Fed is saying that you're going to get. So the bar is a little bit higher to what do I do with this information in my portfolio when you look at, well, you know, the bond market's really quite priced a lot of that in. So it makes it a little bit more tricky than just saying, oh, the Fed's going to cut rates and I should back up the truck and buy a whole bunch of duration. Well, a lot of that trade has happened in the last month. So if you're just talking about maintenance cuts and the degree of maintenance cuts that are required, is what you were talking about with Bill Dudley a minute ago. We don't really know where that neutral is. So how do we know where neutral is? You know it when you see it, meaning you know it when you see it in the data. So if the economy doesn't slow and that unemployment rate doesn't continue to rise, and it says you're not so restrictive as you think you are. And I think, you know, we just kind of have a pile up on one side of the debate here when the data is still saying 2.6% PDFP. He said it twice during the press conference. He also said the other thing that has been supportive of restrictiveness, interest rate sensitive sectors and the slowdown in the labor market. But it's a more balanced view around this debate around how restrictive we are than where the market is kind of lining up. And that sets up an asymmetry to the outcomes.
Hey, Jeff, you're a great student of history. And if we have the headlines that John Ferro was talking about there of Tehran and Israel, and for that matter, up to Lebanon as well, how far out the full faith and credit curve does politics, does war, do our fears play in? Is it short term? Is it out to the 2-year pinch? Or is it out even further to the 10-year note?
So I'm going to frame that in that question, or my answer to that question, in terms of how does the kind of flight to quality response in the bond market play out in this environment. I've said this on the show maybe a couple of times. We've written about it. That flight to quality during the QE zero interest rate policy environment was a curve flattener. If you're very close to zero rates in the front end and you're looking for portfolio protection, you buy it in the long end. Today, we're in a very different environment, 5.25 to 5.5. There's plenty of room for the front end to go down. And so it's more of that pre-GFC kind of bond market reaction where flight to quality is a steepener and it's in the front end of the curve. So I think you see the most powerful reaction. It's hard to disentangle the high frequency between the news that Jonathan broke and the result of the press conference, but you do see a little bit of a steepener move into the market. Again, hard to disentangle the two, but I think when you take a step back, flight to quality now is the steepener trade, and your better yield response is going to be more in the front end in this kind of environment.
What's interesting to me today, Jeff, is what's not rallying on the heels of some of those headlines, especially in light of the Fed's dovish tilt, yes, but they did not cut rates. It's that the dollar is not catching a bit. It's weakening pretty dramatically. You're seeing the Bank of Japan very happy today. They're getting what they wanted in terms of a little bit more yen strength. How much is this sort of the new narrative that in a flight to safety type of moment, if the Fed is going to cut rates and not recognize that upside risk, you will see persistent dollar weakness heading into next year?
It's a tricky one, Lisa, because, you know, on the one hand, you've got kind of interest rate differentials driving some of those dollar moves, clearly with the yen, balanced against the other side of flight to quality, which is the pure risk-off trade, is usually dollar strength. You go for the strongest institutional protection in terms of wealth, and so I think initially the move is much more about interest rate differentials, and that's why you're not seeing so much of the move on the dollar. I think it's too soon to say whether or not you're going to see a bid to the dollar from geopolitical risk. But I think if it was a larger issue that spreads, you're going to think more traditionally that's going to be dollar strength.
You got to jump John and gold up $41.
Got a big rally in the bond market too, and equities as well. Jeff, just final question before I go. There's people watching, listening to this program right now. They just want to know, can I buy the S&P 500 and take a vacation? Is there anything to worry about between now and September?
Well, you know, you never want to say take a vacation.
No.
You know, buying equities, you've got some risk, but you take the totality of what the chairman went over. And this is a lot of good news. I mean, this is a chairman basically saying, without saying it, we've achieved the soft landing. That's a great outcome for the equity market. It's a great outcome for the economy. It's a great outcome more broadly. So I think that's the takeaway, and generally that's going to be pretty supportive. I think the other thing just to mention, obviously, you know, you're not really buying the S&P 500. It's not the economy. It's a collection of stocks that has a very high weight to a secular secular technology theme, and that secular technology theme is playing out again today following Microsoft's earnings. You're seeing a bid back to semis. So you've got like the micro story there a lot, as well as the policy story. And we got to keep that in mind when we're looking at this high frequency data. And if you're buying the S&P 500 with a very high historical share to tech, it's really also buying into that tech story as much as it is about the macro economy.
Just trying to take a vacation. Jeff, appreciate it. Jeff Rosenberg there, BlackRock. Jeff, thank you. Deeply thoughtful stuff going into payrolls on Friday. We should share with you the numbers that we're looking for on Friday. Just another sneak peek of the payrolls survey here at Bloomberg. The median estimate is 175 on Friday. The previous number, 206. Unemployment coming into focus much more for many of you, I know. So here's the estimate for unemployment, 4.1%, in line with the previous month of 4.1%, Lisa.
And the reason why it matters, that unemployment rate, possibly more than anything else, because if it gets to 4.2%, it triggers the SOM rule. Bill Dudley talking about why that's important. At that point, historically, it becomes a self-reinforcing mechanism of weakness.
The difference is you and I are taking vacation like 18 hours. Pharaoh's taking 18 days. That's the difference here.
Actually, I'm missing Friday because I'm going to be on vacation.
Thank you.
You're missing job site? It's un-American.
It had to do with kids' schedules.
Look, as a manager here at Bloomberg.
Blame it on the kids.
As a manager here at Bloomberg.
Are you going to blame it on the kids?
I track everyone's vacation.
Oh, do you?
Oh,
absolutely.
Yeah, is that correct?
You've both taken much more than I have.
Oh,
okay.
Please.
Just for the
Do you
record.
have a bar chart of it?
I do. At home, it's a spreadsheet. I load up the Bloomberg terminal and I monitor your vacation at the same time.
That's
All right?
such productivity.
Missed this, haven't we? Appreciate it. It's good to see you, TK.
Yeah, please.
Thank you, sir. Lisa, thank you.
Thank you.
Are you going to bless us with some of your criticism of the Federal Reserve tomorrow?
Yes, I'm going to have commentary that blesses
love
them
that
very
line.
frequently.
Is there an
That was
auction
fantastic. No, but there
That's
is
the line
plenty
of the press
commentary.
conference. That
That
really
was.
is. Coming up on the close, don't miss this. Stuart Kaiser of Citi, David Kirkpatrick of Techonomy, and a former Fed governor, Betsy Duke, as we round out the month of July from New York City. This is Bloomberg.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we're convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at BloombergLive.com/powerplayers.
أشرقت نفسي بنور من فؤادي حينما رددت يا رب العباد وانتشت روحي وصار الدمع يجري يا إلهي خذ بقلبي للرشاد أشرقت نفسي بنور من فؤادي حينما رددت يا رب العباد وانتشت روحي